to really support the average consumer. Is that how you see it, or is that overly simplistic and a sort of Western shaded view that doesn't take into account certain things that maybe domestically people are touting more?
Well, look, domestically, China set a growth target of about 5% for this year. That means the authorities have to hit that. And one of the key cogs in meeting the target is the manufacturing sector. When you have the real estate sector in the slump that it is, early stages of a turnaround, when you have the consumer side of things, somewhat subdued relative to where it should be, that leaves the manufacturing side, and they are trying to juice the factory side of things to generate what growth and activity they can. So remember, the political objective here is to hit that 5% target. Now, of course, along the way, that brings up problems of its own, which is they're manufacturing a lot of surplus goods that they clearly cannot sell at home, and they are putting those into the global market, and that's stoking the political demand. But where the Chinese authorities will respond and counter is that they would say, look what we're doing now in the property sector. We are putting money into that sector. We are making it easier for people to get home loans and for developments to get finished, giving cheap financial aid through the banking system there. That will stoke domestic demand, and that will get consumers buying more produce at home. So remember, the political objective for China, they have to hit the 5% target. Yes, that stokes criticism of what they're doing in the manufacturing side, but they will say they're putting money on the table and trying to revive the real estate sector too.
One thing that was apparent over the weekend from the Singapore meeting, where everyone got together from the foreign ministries of a host of different governments, was that both the U.S. and China were both trying to appeal, particularly to Southeast Asia, to say, get on board with us. Do you see economically China making inroads that are greater than the U.S. is, particularly in the region, as they try to shore up sort of an alternative axis to what they see with U.S. pushback becoming increasingly apparent?
I think China is clearly deepening its trade linkages in the region. Take the great supply chain readjustment story that's going on at the moment, for example, Lisa. Production that has shifted out of China has shifted into part of Southeast Asia, but it remains very much part of the China value chain. So when you listen to governments from that particular part of the world, they're always keen to stress they're not going to choose sides in this. They're kind of emerging, if you want to call them, as middle connector type economies. Your Vietnams, your Malaysias, they're doing business with both sides of the world. The US is obviously involved, suffering optically because of the Israel-Gaza conflict on the one hand. China, of course, steering somewhat clear of that, and they are taking advantage of the pressure on the US diplomatic look globally. They are continuing to deepen their economic linkages, not just in Southeast Asia, but in the rest of the world. And don't forget, trying to peel off Europe from the US too. Don't forget that visit by President Xi to Europe only a few weeks ago, making clear the case that China remains open for business also as an alternative to the US.
And speaking of choosing sides, the former president has joined TikTok, the platform he tried to ban several years ago. Whose side are some of the leaders actually on regarding this effort to ban or ultimately sell this platform?
I mean, it's fair to say this has become a very confusing topic as a symbol of US-China economic relation, Jonathan. Obviously, domestically, it speaks to its potency as a political communications tool, I suppose. But there's no doubt that, President Trump, he led the push to ban it when he was in office. Then, of course, he did that U-turn when Congress were looking at it a few months ago. If anything, it speaks to the idea that, yes, if there's a change of administration, President Trump will be even more hawkish on China trade. That's what he's vowed to do. But there will also be an element of uncertainty, an element of lacking clarity in terms of what exactly China policy will be, given, for example, the sharp U-turns that the former president has performed on TikTok as an example. So I think it speaks to the idea that, yes, US approach to China is broadly bipartisan hawkish, but there's plenty of scope for confusion and volatility within that too.
And this is one of those instances, that's for sure. And thank you, sir. And Karen down in Washington, D.C. attempted to figure out what 25 looks like, and we have no idea. And this is a great example of that. Just how things have changed so quickly over the last several years.
So Donald Trump joined TikTok. This was something over the weekend. He wants to appeal to the younger voters. Biden already has, right? The irony here is that everyone seems to be, at least the bipartisan agreement in Washington, D.C. is TikTok needs to be, brought away from Chinese ownership or at least taken out of the U.S. So, of course, one of Donald Trump's main advisors is a backer of TikTok and a big investor in TikTok, raises this question of, okay, what's more important and how do you understand any kind of framework for next year given some of these uncertainties?
With difficulty. I think it's going to be really, really difficult. to draw broad-based conclusions about what policy will look like in the next 12 months, which makes it even harder. Look at some of these things that some people are saying. Larry Summers to The Atlantic, here's a quote for you. There has never been a presidential platform so self-evidently inflationary as the one put forward by Trump. I have little doubt that with the Trump program, we will see a substantial acceleration in inflation. It's a pretty punchy conclusion going into November.
Well, we saw also this report out of Clock Tower saying that treasuries face a massive risk if Trump gets into power, and other people saying, well, actually, we have no clue what his policies are going to be, and actually either candidate's going to come out with some inflationary policies. There just is a complete black box, and we're all trying to arrange these sort of theories into this black box, which makes us all deeply uncomfortable.
First debate at the end of this month, looking forward to it. Anne-Marie's off for the next several days, for the next week or so before the G7, getting some rest before this campaign really picks up. Equity futures on the S&P 500 positive by 0.1% on the S&P, with an update on stories elsewhere this morning. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Former President Donald Trump, as you guys were just saying, joined TikTok over the weekend. It was a bid to court younger voters. He made his debut with a short clip alongside Dana White, of all people, of the UFC. So again, as you're saying, both Trump and President Biden are now actively on the app that they have publicly called to ban. Trump joined the platform fresh off of his conviction of 34 felon counts in Manhattan. Trump touted that he raised $50 million in the day following the verdict. Saudi Aramco is planning a series of events in London and the U.S. to court international investors. Aramco's $12 billion share sale on Sunday sold out in just a few hours. Key executives will now be attending roadshows in London this week with a separate event in the U.S. Foreign participation is going to be watched closely this time, considering the IPO in 2019 largely relied on local buyers after overseas investors questioned valuations. Shares of Paramount this morning, they are higher by 6.8%. We've learned that the movie producer David Ellison's latest offer for Paramount includes a sweetener. That is, non-voting shareholders would have the option to cash out a portion of their stock for about $15 a share. That's a roughly 26% premium to Friday's close, but it's only for some of the shares. It's the latest attempt by Ellison to court the non-voting shareholders who feared his bid too heavily favored Sherry Redstone and her controlling class of shares. And that's your brief, John.
Danny, thank you. That stock higher in the pre-market by close to 7%. More from Danny in about 30 minutes' time. Up next on the program, pre-committing to a rate cut.
The ECB's already committed to cutting rates in June, and they're going to do it, even though the inflation data that we got recently doesn't really justify them to cut rates in June.
So rate cuts in June and then a big fight about July and beyond. That's all coming up this week. From New York City, this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg.
Equity futures just about positive by 0.1%. Quiet start to the week, to the month. It gets busier as this week progresses. In the bond market, yields lower by 2 or 3 basis points. On a 10-year, 4.47. In foreign exchange, the euro just had its best month of the year going back to November of last year. Euro dollar positive on the month by 1.7%. As we kick off June, just a touch weaker by 1/10 of 1%. Euro dollar 108.32. Under surveillance this morning, pre-committing to a rate cut.
The ECB is already committed to cutting rates in June, and they're going to do it, even though the inflation data that we got recently doesn't really justify them to cut rates in June. The question really becomes what comes after that.
That's the big question. So here's the latest. This is how things stand. Investors expecting the ECB to kick off the rate cutting cycle on Thursday. Despite recent upside inflation surprises, the bank is also set to release new forecasts, setting up the big debate for the next move. And July is very much in sight. Sonia Martin of DZ Bank writing this: the ECB will take extra care not to send aggressively dovish signals for the remainder of the year. Data dependent is going to be the name of the game. Sonia joins us now for more. Sonia, how big is this fight going to be? Not about this month, that's done, according to the officials we've heard from. How big is the fight going to be about July and beyond?
Well, it's definitely going to be a very lively debate. The problem, as has been mentioned on your program just now, is that the inflation data recently has been somewhat disappointing. We've seen a renewed pickup in inflation dynamics. There's been some disappointment as far as the wage data is concerned, and that has, raise the bar. The ECB will cut this week. They've committed to this. But of course, what comes after that is going to be much more difficult and very much data dependent. They are not going to rush into a next rate cut right away. I think an approach where they cut once a quarter is much more realistic, because that gives them time to look at the data, see how the inflation develops. And basically what they will need to see is that the disinflationary trend continues to pick up pace again. And that's going to take a little bit of time. So I'm thinking they're going to cut now, and they're going to wait until the coming next quarter to do another move, and then one more before the end of the year. But the language is going to be very, very cautious on Thursday.
Your line of thinking seems to be in line with what Deutsche Bank is saying as well. This is what Deutsche Bank have got to say. We've moved the balance of risk from 4 cuts to 2 in 24. The baseline is 3. Rather than a terminal rate of 2%, we now see a landing zone for terminal of 2 to 2.5. Deutsche Bank putting the emphasis on optionality over normalization. Sonia, it feels like we won't talk about normalization on Thursday, but I've got to ask you, what do you think the ultimate destination is? We're having this conversation stateside about where neutral might be in this economy post-pandemic. What's that sound like in Europe at the ECB?
Well, I mean, this discussion about the neutral rate, I think, at this point has become almost entertaining, because when you think of how many times the market has been revising its opinion on where the neutral rate might be, I'm not really that interested in trying to second guess that again, because to be honest, it's a moving target at this point. What I would agree with is that definitely it is higher than we thought it was going to be for a long time. And that's, there are structural issues, there's inflation, there's a lot of debt issuance, there are reasons for why rates will remain higher for a long time. The ultimate destiny, as far as the ECB is concerned, unfortunately, doesn't just depend on the ECB, and it will depend also very much on what happens in the US with the election coming up, because whether Trump or Biden becomes president will have a massively different impact on the European economy, right? Trump being much more negative for Europe, and that would suggest that the ECB can cut more next year. If Biden wins the election, that looks a bit different. So the US election has a big role to play here for the ECB as well.
Well, the U.S. election is a black box, so it's unclear exactly what the ECB can do ahead of this, other than just not provide guidance. I do wonder, though, as an FX trader, whether long euro is sort of the new hot trade, given the fact that the economic data is coming in stronger, and at least the ECB is going to launch its rate-cutting cycle in a way that the Fed seems far away from.
Well, I'm going to say this. I was never a big fan of the whole parity discussion that we had not so long ago. Equally, I'm not a big fan of a discussion about becoming overly bullish on the euro. You're perfectly right in saying that we have seen some positive news out of the Eurozone. And if you look at the indicators recently, then, the numbers have been better than expected. We've seen some relief, especially in countries like Spain or Portugal, some very strong data there. So it's moving in the right direction. And that is supportive of the euro, despite the fact that the ECB will be cutting cutting rates before the Fed. Having said that, I mean, this recovery that we're seeing in Europe is a very anemic recovery. It's not a very dynamic recovery. It's based on growth in the US and export and some consumption, but it's not a very strong recovery. So I don't think it's enough to justify a very bullish take on the euro. And I also don't think we should quite give up on the US dollar either, which is still looking very solid, despite the fact that here we have seen some disappointment in the data of late.
You did mention the election, and so let's go there, because it seems like right now you don't see a real catalyst for some sort of dramatic action one way or another based on the sort of soup of information that you just laid out.
Yeah.
How is the election kind of shaping your trading strategy heading into the end of the year, considering it's kind of a black box, A, who's going to win, B, what that's going to look like, and C, what their policies are going to be?
Well, basically what we're doing, which I think many houses are doing, we're sort of driving two scenarios at the same time. We have a Trump scenario, we have a Biden scenario, and basically what we're telling clients is, kind of go where your conviction takes you personally. We can't predict who's going to win the election, but what we can say is the Trump scenario is definitely the dollar positive scenario. That's the scenario where we can see your dollar moving towards parity, at least initially. So this is a very short-term affair. This is going to be dollar positive initially, because it's going to be good for U.S. growth initially. Now, what happens in the longer run becomes much harder to predict, simply because, well, none of us really know what Trump is going to do, but we suspect that his economic policies are going to backfire and therefore become a risk as well for the dollar. But short term, it's positive. So if you're betting on Trump, then yes, you're definitely looking at short euro dollar here.
Sonia, what are the policies specifically? What are you identifying here that leads to initially that burst of growth, initially that dollar strength, but ultimately a problem further down the road?
Well, there's going to be tax cuts for both corporates and households. So that's going to be a big boost for spending. It's going to be a boost for investment. That's positive. That's going to boost sentiment. So I think that's going to deliver the initial growth spurt that we expect. But of course, on the other hand of that equation, we have the leveraging of import tariffs, et cetera, which is going to be used to finance these tax presence. But it's not going to be enough. So the fiscal situation in the U.S. becomes more perilous under a Trump administration, and so that's ultimately going to be the medium or long-term problem for the U.S. But initially, again, it's probably going to be positive.
Just quickly, Sonia, you didn't mention the Biden playbook. What's that?
Well, pretty much more of the same, right? I mean, you look at the growth forecast for the U.S. under Biden and a Trump scenario, then actually the growth rate for the year as a whole, 2025, is not that different. The big difference is the path. So with Trump, we have an initial boost of growth, and then it sort of dies down and it becomes much weaker. With Biden, it's more sort of a level playing field, which will make the job for the Fed a lot easier than it would be under a Trump scenario, where they might find themselves, sort of handicapped by the fact that inflation is probably going to rise rapidly as a result of import tariffs.
Sonia, appreciate the update and the perspective, the opinion from Sonia Martin there of DZ Bank. Here's another one for you from Peter G of Academy. The one thing I'm reasonably sure about regarding the election is that as campaigning begins in earnest, it will not be great for treasuries. Goes on to say, neither candidate and or party seems particularly interested in doing anything about the ballooning national debt, and that will weigh on markets yet again. Irrespective, regardless of who the candidate, the winner might be come November and beyond.
We've heard this from everyone. No one is talking about reducing the deficit, neither candidate. And if you look at the Biden administration, he's talking more about spending. And if you look at the Trump administration, it's what you're going to see with ongoing tax cuts. So where are we going to deal with the deficit?
We'll be talking about this in the next hour. Look out for that. Coming up on the programme, we'll catch up with Dan Greenhouse of Solace Alternative Asset Management, Terry Haynes of Pangea Policy, Morgan Stanley's Michael Kushner, and United Airlines CEO Scott Gerby sitting down in the Middle East with Guy Johnson. All of that in the next hour on Bloomberg Surveillance.
The world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company, This guy ran a major division, Warner Discovery.
Okay.
It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
With the worry once again that the Fed could be raising interest rates, that's what's in a sense causing cracks to form underneath the confidence of investors today.
The sort of volatility of expectations is really what's confusing investors.
The most likely scenario for the Fed is that they start easing in Q4, most likely September.
For the Fed to think about moving earlier, they're going to have to see more stress in the labor market.
I think we're in a good place for the economy. I'm trying not to overthink it too much.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
We live and breathe to overthink it. That's what we're here for. It's exactly what we'll do over the next week. Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance begins right now. We'll keep going back to the calendar. The calendar is absolutely stacked for the week ahead. We can start for the week ahead. We're just looking at jobs. We'll get the ADP, ISM prints, manufacturing and services, a central bank decision, the ECB, the appetizer for the Federal Reserve a week away.
So to me, I think it's fascinating because we saw a shift in May. We began real strong, and then it sort of faded with the first weekly loss going back to the weekend at April 19th in more than a month. And it comes on this idea that maybe there is some true weakness under the hood, and that seems to be an increasing fear. So if we get a downside surprise, I want to see whether risk assets really rally in tandem with bonds, or whether we start to see maybe weakening for the wrong reason, rate cuts for the wrong reason.
You've alluded to this twice now. I think the most important thing this week is not just the data, it's how the market responds to it. So let's take payrolls. The estimate for Friday, 190. Previous read, 175. Do you have a decent idea for how this market's going to respond to an upside and or downside surprise?
Well, if you take a look at Citigroup's Andrew Hollenhorst, he talks about sub 150. Suddenly you could talk about July rate cuts again. That essentially it's the labor market cracking that's going to allow the Fed to really step in and enact some of its easing, or at least mid-cycle adjustment policy, whatever you want to call it. To me, I wonder, though, he sees this as potentially a negative for the economy and what this means economically. I can't imagine that stocks can rally tremendously in that. Maybe you could see small caps gain materially in just on the margins, but recent activity has not shown that being a boost, given the fact that there already have been such accelerated valuations.
If last week was boring, this week is anything but. Let's kick off with the scores. Equity futures on the S&P 500 positive by 0.2%, just a little bit of a lift. We're down by 3 basis points on a 10-year to 446.50. In foreign exchange, the euro weaker, going into what many anticipate will be, in fact, almost everyone apart from one in our survey anticipates will be the first interest rate cut for this cycle from the ECB coming on Thursday. Euro dollar 108.39, we're negative by 0.1%. Coming up this hour, we'll catch up with Dan Greenhouse of Solus Alternative Asset Management on why the Fed is likely to cut this summer. Michael Kushner of Morgan Stanley looking ahead to Friday's payrolls report, and the CEO of United Airlines, Scott Kirby, on summer travel. We begin with our top story, equities inching higher as investors shift their attention to Friday's payrolls report. Dan Greenhouse of Solus Alternative Asset Management saying this: inflation is slowly and is likely to continue slowing, but remains too hot right now for the Fed to justify near-term cuts. But with the economy slowing and presumably further labour markets slowing, the Fed will probably again feel justified in cutting rates at some point after the summer. Dan's with us around the table. Dan, good morning to you.
Good morning, sir. How are you doing?
I'm good. Can we start on Friday? What are you expecting on Friday in the payrolls report, and how do you expect this market to respond to it?
I don't think that there are no indicators that we use to forecast payrolls that suggest any meaningful deviation in the amount of job creation, whether it's 190, 170, 210 is largely irrelevant. We're still adding a healthy number of jobs, and I think from Lisa's comment just before about weakening in the labor market, there's nothing to suggest that this number is going to come in at 80 or some meaningfully weaker number that would raise alarm bells inside the Fed or the investor community.
Lisa's broader point was how the market might respond to that, and that's been difficult. Let's take NVIDIA as an example, maybe the example. Come out with numbers, pretty decent, beat and raise, we're used to that. Stock runs up 30% or so for the month of May, and the equity market doesn't run with it towards the end of May. These are things that we would have said would have happened and didn't. What did you make of that?
Well, listen, I mean, NVIDIA is, I don't know even how to describe it anymore. It's obviously an exceptionally powerful company, driving revenue, driving earnings growth, changing the narrative both for the market and the economy as a whole. So I don't know that you can make any larger comment about NVIDIA and its performance or the market and its performance. At the end of the day, I think there's just in a larger sense with respect to what's happening, there is another secular shift going on here. This is not a new story. It was desktop, it was mobile, it was cloud, it's AI. I mean, we know this story.
Apparently it's desktop again.
Listen,
with AI,
I never stopped using. We're on desktops now. So
I am right now.
I don't think it's ever gone away.
Bloomberg terminal loaded.
Yeah, I think this is just a powerful narrative that's likely to be with us for years. I don't know market-wise that you can really read anything into it because it's unlike really anything that we've seen.
Although there was a feeling that you could never price this narrative highly enough, right? And that seems to have faded, right? So maybe this is the reason why, just to build on John's point, people took a real signal from the price action because it seemed like when you looked at the numbers, it wasn't being adopted as quickly as people previously thought, that AI wasn't being monetized and wasn't spreading its tentacles of glory to all these different industries in quite the same kind of way. You don't read that into what we've seen.
Yeah, listen, I mean, obviously the rates of growth will slow at some point and the law of large numbers will kick in. But I also, to the extent that we use the 90s tech boom as an analogy, the Netscape IPO was the middle of 95, and we're still living with the repercussions, so to speak, of that today, decades later. And I'm wary of making larger narrative adjustments to this change based on 1 quarter, or 2 quarters, or 3 quarters. If this is going to be what we all think it's going to be, then we're going to be reaping the benefits, so to speak, for the next 20, 30, 40, 50 years. 1 quarter to the next is largely irrelevant to me in that sense.
I get the sense that you disagree then with Michael Hartnett, who basically is shifting his anything but bonds thesis that he had in the first half of this year to, well, if you see a little bit of a pullback in bonds, buy it. Because if the Fed cuts rate, which they probably will, bonds will look good and stocks less so, because it will come on the heels of weakness. Do you agree with that, or do you think that rate cuts are actually incredibly supportive of further gains in valuation, regardless of why?
I don't have, in my forecast, I don't have some material economic weakening. You mentioned before cutting rates for the right or the wrong reasons, to borrow a phrase from The Bachelorette. I don't have the Fed cutting rates for the quote-unquote wrong reasons. Now, again, I could be wrong. Wouldn't be the first time, certainly won't be the last. But I have, as the year progresses, inflation continuing to drift down into the mid-2s, that should be, along with the type of weakness that I think everyone is expecting in the form of labor market weakening, maybe some additional consumer weakening, that should give the Fed some breath to reduce interest rates. Now, obviously, the election complicates that, and any stickiness that we see, further stickiness in inflation that we see, is going to complicate that story. But I don't have a material weakening. Now, that said, with respect to bonds versus stocks, I think there's a larger conversation here with respect to weakness in stocks. And I think that a much larger conversation should be had about the difference between the market-weighted S&P and the equal-weighted S&P. I don't think that enough credence or enough benefit is given to the Fed for slowing things down if you look at the equal-weighted index. I mean, there's this argument that the Fed's raised rates up to 500-plus basis points, and you've seen no material weakness in stocks. That's not really true.
So what I'm hearing from you is you like small caps if the Fed cuts.
No, I actually think the Russell 2000 conversation is, I don't know why we talk about the Russell 2000. This is an index of stocks that...
Okay.
No, but I still like, listen, coming into the year, I was asked, do you prefer the equal-weighted S&P versus the market cap-weighted S&P, and I said the equal cap-weighted S&P, which obviously has been wrong.
What about now?
I like the broadening theme, but now, mind you, Solus is a idiosyncratic. We're a hedge fund. We're an absolute return vehicle. We're looking for most attractive risk-adjusted returns in equity, in credit, et cetera, et cetera.
Do you find them in stocks or credit?
Well, certainly stocks. I mean, in both, but there's a narrowness to the credit market right now that's undeniable. Double Bs and down in the lower rated portion of the market where we spend some time, double Bs, single Bs are trading as tight as they've have in forever. A lot of the work is being done by triple Cs. What are triple Cs? It's Lumen, it's Frontier, it's Dish, it's Altice. These are not the best companies, so to speak. But there's a lot of stuff to do there in credit. I think just on balance, we have found more to do in equity. And to that point, again, we're not an indexer. We're not trying to hug the index and beat it by 100 basis points or whatever. There are themes that are playing out. Since we brought up NVIDIA, I've mentioned this a number of times, but I'll do it again because I think it's important. Yes, we need chips, but we also need to build the data centers. And someone's going to build the data center. And someone's going to cool the data center. And someone's going to build the racks for the data center. And all these themes are playing out in the market right now at exceptionally profitable ways. They just don't get nearly the attention that the Mag 6, Mag 7, Mag 8, whatever it is on any given day get because they're so large. But these other names, these are multi-billion, tens of billions, hundreds of billion-dollar companies. They just don't get the attention, and that's fine for investors that are in those themes. They're reaping those benefits without getting the public attention that might drive a blow off top.
Let's tease this out just a little bit more. Utilities, they got some attention in the last month. Is that where you are? Is that where you're focused?
We're not doing too. Listen. We certainly have done plenty in utilities, but utilities is a good example. I mean, listen. Getting back to the narrowness of the S&P, only 3 sectors are beating the S&P this year: tech, comm services, and utilities. What's even more narrow, what's even more interesting about this, is within tech and comm services, just 40% of those respective sectors are beating the S&P, and in utilities, it's just a third. So you have a steadily narrowing market, no matter how, depending on how far you want to go. Are we finding stuff to do in utilities? I mean, listen, we paid attention to the space. But again, to the point I just made about just a third beating the S&P, if that's your goal, there's a very select few of names that are doing that.
We write a lot about how much money has gone into private credit, private equity funds.
I hear it's the golden age.
I hear it's the golden age as well, which means it's also the golden age of competition to find all of these opportunities. I mean, how much is that a concern for you, given that everyone's looking for the cooling center or who's going to get the strongest floor to hold the weight of some of these chips? I mean, all of the sort of stories that people are looking for any edge at all at a time where there just seems to be a glut of cash.
Yeah, I don't think that's really any different than any time in my career or really any time in modern market history. Competition has always been there for companies. Competition has always been there for asset managers. And over time, performance wins out, so to speak. Now, mind you, we don't do a ton of private credit, so to speak. We have done idiosyncratic loans over the last 10, 15, 20 years, but I don't think it's a regular part of our investment thesis. What we're trying to do is find the best risk-adjusted return, whether that's in equity or credit or wherever it might be. And I think to the point earlier, the question earlier, there's stuff to do in equity, there's stuff to do in credit. Just on balance, I think we're finding a little bit more to do in equity right now. But again, that at any given moment, including when I walk out of here, that's likely to change.
Is it more likely to be in the U.S. than anywhere else?
Yeah, we spend a lot of time in the U.S. We have a fairly large position an environmental waste company up in Canada. We've done a bunch of work down in Brazil where there have been some idiosyncratic issues in which we've invested. We have some work in Europe, specifically London, but Europe as well. But on balance, the portfolio is domestic. That's where our focus has been, and is probably likely to stay, given some of the risk, particularly in EM, that we're not as comfortable with right now as perhaps we were in the past.
I get a mid-90s feel from you. Is that fair? Sort of don't overthink this. It's going to be all right. Couple of adjustments here and there.
I tend to take a very simplistic view of, maybe some might say naive, but a very simplistic view of the investment landscape, which is corporate profits are expanding, the economy is expanding. Obviously, valuations are an issue, but in that context, the Fed is likely to start reducing interest rates. All of that on balance is positive if you find the themes that you're able to exploit. And it's not easy. I mean, if it was easy, we'd all be, nobody would be sweating every day the way that some of us do. But again, as long as the economy is expanding, we're finding opportunities. I think don't overthink it. I mean, I heard you mention before about the Treasury issuance and the coming election and its effect on fiscal spending.
Regular listener.
I quoted the 5 o'clock hour, and now I've quoted the 6 o'clock hour.
Okay.
I do my homework.
You're critiquing Bloomberg.
I don't just show up here without...
Bramo's thoroughly entertained by the fact you've got sheep on your tie.
I know. What's the meaning behind it?
I don't want to say on air.
All right, then.
Dan, thank you. We'll leave that there.
Always my pleasure,
You're welcome back anytime.
Thank you.
Thank you.
I don't know why this isn't a weekly thing. Come on.
Of Solace Alternative Asset Management. Maybe it should be. Write in with your own complaints. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. South Africa's ruling African National Congress has begun talks with its rival to form a government. The party had lost its parliamentary majority for the first time since Nelson Mandela led them to power at the end of apartheid in 1994. The leader of the ANC, Cyril Ramaphosa, says that the result is a sign that South African people want more cooperation between major parties. Ramaphosa's ANC got a vote share of just over 40%, down from more than 57% 5 years ago. OPEC Plus has set out a timetable for gradually unwinding some of its oil production cuts. The new agreement extends the voluntary curbs from key members like Saudi and Russia well into 2025. It also begins rolling back those supply reductions in October, earlier than some OPEC watchers had assumed. Goldman called the decision bearish, that the plan to unwind cuts would, quote, make it harder to maintain low production if the market turns out softer. And GameStop shares are surging in the pre-market nearly 90% because Roaring Kitty is back again, for real this time. The Reddit account that fueled 2021's meme stock mania posted what appeared to be an $116 million position in GameStop. Keith Gill, who's known as Roaring Kitty on Twitter, posted the screenshot in the Super Stonk subreddit, because where else would you put something like that? It's his first post to the platform in 3 years. He also tweeted an image of a reversed Uno card for whatever reason. Gill returned to Twitter in mid-May, which in itself caused a leg higher in GameStop. A bad day if you believe in efficient markets. And that's your Bloomberg Brief, John.
Danny, appreciate the update. More from Danny in about 30 minutes' time. Up next on the program, Trump staying strong after his conviction.
The judge could decide to say, hey, house arrest or even jail. It could face what that could.
I'm okay with it. So that could happen. I don't know that the public would stand it. I'm not sure the public would stand for it. But at a certain point, there's a breaking point.
There's a breaking point. We'll talk about that breaking point next on the program. Live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
We are seeing the labor market come into better balance.
That foundation for the economy is solid.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is not a labor market that's slowing down or grinding to a halt.
Which is why everyone is looking at wages.
Payrolls report, 8:30 Eastern Time.
The May Jobs Report, Friday on Bloomberg.
The payrolls report, 8:30 Eastern Time on Friday, a few days away. Before we get there, equity futures look like this on the S&P. Positive by 0.2%, yields lower by 3 basis points on a 10-year, 446.50. Under surveillance this morning, Trump staying strong after his conviction.
The judge could decide to say, hey, house arrest or even jail.
It could.
Face what that could be.
I'm okay with it. I saw one of my lawyers the other day on television saying, oh, no, you don't want to do that to the president. I said, you don't beg for anything. You just, the way it is. So that could happen. I don't know that the public would stand it, I'm not sure the public would stand for it. But at a certain point, there's a breaking point.
It's the latest this morning, a new Morning Consult poll finding that more than half of voters approve of former President Trump's conviction, but a large majority of Republicans still want him to run. Just 15% of GOP voters wanting the former president to drop out. For more, Terry Haynes of Pangea joins us now. Terry, what are you learning from the post-conviction polls of the last several days?
I'm not learning very much yet, John, because I think they still have a lot of time to play out. These are essentially weekend flash polls, and I think that whatever the effect is on Trump, it's going to take days and weeks to play out, frankly. Meanwhile, Trump has the same situation in that he's had before, which is he's got a split Republican Party with anywhere from 20 to 40% of Republicans not preferring him, and he's also underwater with independents. If he doesn't right that both of those ships, I think he likely loses in November.
Terry, how do you think the sitting president will navigate this issue in the big debate at the end of this month? Is this something he tries to campaign on?
Well, I think what he does is really two things. One is, and there's some tension here in both of them. One is he personally tries to stay above the fray, and the other one is that he and the campaign repeat convicted felon over and over as much as possible. I think what ends up happening is, though that Biden needs two things for the next 5 months. He needs to put the cognitive issues fairly well at rest, and the other thing he needs to do is look like the steadier alternative. I think those are the frames of the campaign. A lot of political people will say, well, issue X or issue Y will be the make or break. Really what it's going to be is, to the extent it's a referendum on Biden, it's a referendum about whether he continues to be up for the job, likelier than not that people conclude that. And secondly, that he's the steadier alternative to Trump, and that independents, particularly and some Republicans, don't want to return to the old days.
Terry, I want to go back to something that you said, where you said Trump has split the Republican Party. Is that still true, given some of the consolidation that we've seen around Trump by Republicans over the past couple of days, even with the conviction basically coming out with the party line that it was a flawed prosecutorial discretion in terms of trying the case, where it was tried, that it wasn't a venue change, et cetera, et cetera. Do you view this as truly splitting the party?
I don't view the Trump conviction as splitting the party. I view the party as split since about mid-January when the first primaries happened. The reason I look at it that way is because I'm not relying on the polls for this. I'm looking for how people actually voted, and what you've got is a Republican Party that by all indications doesn't completely want Trump. And the thing is, Trump has demonstrated that he knows this in the past several days, several weeks. The reason why I say that is because he's gradually pulling out every stop he can to try to court Haley into the tent, and Haley's the protest candidate essentially. And Haley said that she'll vote for him, which is not really working for him or anything serious, but that he needs to address the needs and concerns of those many people that voted for him. There's a dance going on right now, may be successful, may not be, to try to get Haley into the tent and actually unify the party. But it's not there yet, but it's real.
Terry, I also wonder your take on him joining TikTok over the weekend, this idea that Donald Trump has sort of wavered just a touch in terms of whether he would ban it or not, what the sort of messaging is. How important is that type of thing to the support that he's going to get or not among the electorate? Or is that window dressing at a time where there are much more fiery talking points on both sides?
Well, the policy of both Biden and Trump on TikTok is as far as an election goes, is nothing more than convenience. I mean, you can hear the political people whispering in everybody's ear saying, look, we have to use every weapon we possibly can to get to the maximum number of voters. We've got to use TikTok. There's no alternative. So they both go ahead and do that. And they will both go ahead, just as they do with campaign finance, for that matter. They will use every tool available until it's not available anymore. And then they'll go try to use something else. So the consistency is the hobgoblin of little minds, like Emerson said. But when you're in hand-to-hand combat for the next 5 months, expediency is going to rule overall.
Terry, I'd love your thoughts on policy. Let's continue that conversation. Larry Summers to The Atlantic saying this: there has never been a presidential platform so self-evidently inflationary as the one put forward by Trump. I have little doubt that with the Trump program, we will see a substantial acceleration in inflation. Peter Chi of Academy pointing out there's not much distance, daylight, between the two candidates when it comes to this issue. How much daylight is there currently?
You know what? If I vote between Summers and Cheer, I'll take Cheer on this one. The fact of the matter is that it's a campaign season. Campaign seasons want to overemphasize differences. That's part of what the campaign and the argument is all about. But in reality, what you've got is a situation, for good or ill, where there's not going to be any fiscal discipline in the United States, regardless of who the president is. There is a situation where foreign policy will largely be united, just as it is now, very bipartisan. Issues on the margin. And what you're going to see is a move towards shoring up, improving, and pumping up the defense industrial base. And that is I think that's a very big deal, and frankly unifying. I think Trump will do it. Trump will want to do it at somewhat of a faster pace than Biden, who's trying to get the Goldilocks move, the just right move here, without alarming people. But that's going to happen. And so there's not a lot left, really. Markets get excited about regulation, but based on 2017 particularly, that's a triumph of animal spirits over reality. No business is going to get deregulated.
I'll let Pete know that he gets your vote. Terry, thank you, sir. Terry Haynes of Pangea. Equities right now positive 0.1%. Coming up, Michael Kushner of Morgan Stanley, looking ahead to payrolls on Friday, and a little bit later, Mr. Kirby out of United Airlines with Guy Johnson. That's about 15 minutes away.
always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
2 hours away from the opening bell, equity futures look a little something like this. We're positive across the board to kick off the month of June. We're up by 0.1% on the S&P, on the Nasdaq up by 0.4. There is your outperformance. It's a new month, so we talk about the same old conversation. Can we get that big rotation to Russell, small caps? The Russell up by 1.2%. Lisa was talking about the prospect of weakness for payrolls on Friday. I said, what is weak? Stuart Kaiser was listening over at Citi. He says payrolls may be a banana peel. The mix could be equity positive in our view, but headline payrolls below 150 would be worrisome. Citi's looking for 140 on Friday. The median estimate is 190. So there's your answer, Bramo. Sub 150, according to Stuart Kaiser, would be worrisome.
And I would guess that Andrew Hollenhorst, over on the interest rate section of his bank, would agree with him, basically talking about how this would indicate rate cuts for the wrong reason, and everyone can roll their eyes. This is sort of good news is bad news, and bad news is good news kind of cuteness. But basically, what you would get is real weakness in the economy not being supportive of risk valuations that have gotten pretty elevated. And that's, I think, the interesting sort of twist that we've seen also from Bank of America recently.
That takes us to the bond market, so let's set that up. Check out the scores, 2-year, 10-year, 30-year in fixed income. Treasury shaping up as follows. We're down 2 basis points on a 2-year on the session. Over the last month, down double digits across the curve. The 2-year out to the 10-year. We're down another 4 this morning on a 10-year maturity to 4.4591. Given that retreat, this is what foreign exchange looks like this morning. The euro just had its best month of the year. Positive by 1.7%, getting close to 109 at 108.41. We're negative on the session by about 0.06%. But the ECB on Thursday is the main event, and it's not about what they do on Thursday. They're going to cut interest rates in the minds of pretty much everyone on the planet who follows the ECB, with the exception of this one person who I'd love to speak to.
I know, exactly.
Who doesn't think they're going to cut interest rates on Thursday. We'll park that just for a moment. What happens in July? What does the data look like? And the limits of divergence is something we can talk about with Mohamed Al-Arian a little bit later this week when we catch up with him on Wednesday.
I agree with you. This might be the most interesting part of the whole week, especially given the fact that we've gotten hotter than expected inflation data out of Europe, and we've gotten stronger than expected growth. We had Deutsche Bank, you mentioned them earlier. They actually upped their expectation for growth in the second half in Europe by 0.5% while keeping the U.S. the same. So is that positive? Does the ECB try to keep that going with more rate cuts, or do the hawks kind of win out and say, inflation isn't that quick to really kill off?
If you want to find agreement on the Governing Council right now, and this is sort of what Deutsche Bank's alluding to, you'll find it around things like optionality. Keep your options open. Sure, we don't want to shut out July completely, but maybe we don't go in July. You don't want to start talking about kicking off the process of normalization at all. And if you go on some of the communication we've had from, say, Philip Lane, the chief economist on the Governing Council of the ECB, the Executive Board, he's talking about needing to remain restrictive through this year. And within that, you can reduce interest rates, but still needing to remain restrictive. It's the areas where you can find big agreement on the Governing Council that will really start to dance in the news conference on Thursday.
You don't want to talk about normalization because what's normal?
Exactly.
And all of a sudden, if you have to start talking about what the neutral rate is, that's a dangerous place that clearly nobody wants to talk about in any kind of collective way.
What's normal for this stock? Just sort of up and to the right. Let's get to NVIDIA. Under surveillance this morning, the CEO, Jensen Huang, saying the rise of generative AI is a new industrial revolution. Speaking in Taiwan, he said he expects NVIDIA to play a major role as AI shifts to personal computers once again. Huang also saying the company plans to upgrade its AI accelerators every year. That stock is up by another 3% this morning.
Because why not, right? I mean, we start talking about 3%. What is that, an extra, how many, $50 billion? I mean, just the scale of this is just overwhelming. But to me, when I look at this, it raises this question that we asked before. At what point do people not want to buy currently because the future iterations are going to be stronger, more powerful, more efficient? And the answer has been there is such a shortage of chips, and people want to get a head start in this AI race that hasn't mattered. So any advancement is just a benefit. I really am actually curious about how much AMD can follow on, because they came out talking about also some improved technology that they're unleashing. Can they catch up? And that's actually a more potentially surprising question.
Do you think we've had the melt up yet for this stock? Because I often wonder, sitting here in this seat, are we having the right conversation? The right conversation to have at the end of last year was actually whether this stock could double again. That was the right question to ask. Could we do this again? Could we rally another 100% here? And I didn't hear that nearly enough at the end of last year, the start of this year. I'm just wondering, with this name now, what is the right conversation?
So we should be talking about this being a $5 trillion stock by next year?
I've got no idea.
It's a good question. Basically, what is the limit to its ascent, given that it seems to be limitless at this point, up nearly 100% again this year, actually 121%. And we're talking about how they own the market. At what point is there some pushback? And this is what I think will come, is from the big tech giants in terms of their profitability. Start to push back at just how much money they are funneling to NVIDIA's profit coffers in order to get some sort of prowess. At what point do they start really investing more materially in their own chip production? That's, I mean, I don't otherwise see a limit to this.
How long is the runway? That stock is up by 2.9% in the pre-market. Just quickly on Paramount, shares rising in the pre-market following reports that David Ellison is sweetening his offer to buy the company. Ellison is said to be including an option for non-voting shareholders to cash out a portion of their stock for about $15, according to people familiar with the matter. The Paramount chair, Sherry Redstone, is also weighing an option of taking the offer from Apollo Global Management, that combination together with Sony.
This has been sort of the ongoing consolidation that hasn't happened nearly as quickly as people previously expected. To me, it sort of seems like it's shaking out that people with very wealthy people in their lives are the ones that are taking over media, and we're seeing that pretty consistently.
Are you calling this Nepo acquisitions? Is that what you're trying to say? I'm just telling you what I'm hearing.
Well,
is that what you're saying?
I'm just saying that there seems to be that theme going through this, because, you know, otherwise, why are people going through with the acquisitions?
No interview for you if this one closes. Let's get to this. Not for me either, let's be fair. Busy week of job data. JOLTS due tomorrow, ADP on Wednesday, claims on Thursday, and a main event on Friday, the US payrolls report. Investors will be looking for clues about what it could mean for the Fed's path forward. Morgan Stanley's Michael Kushner with this to say: the Fed will cut once or not at all this year, given the current economic situation. Rate cuts only come if unemployment growth dynamics deteriorate. Inflation could easily be too high, given solid economic performance, to cut rates. Michael's with us now for more. Michael, good morning.
Good morning.
Can we just sort of pair this with Friday, what you would expect to see in a few days' time?
Well, it seems that job growth is decelerating, as it probably should. The economy can't keep generating hundreds of thousands of jobs every month and maintain a reasonable economic growth, and growth does seem to be decelerating. Quit rates are slowing, and employment growth seems to be decelerating to a more normal level, somewhere between 100 and 200,000 per month. Don't know exactly where it is. This whole immigration issue makes it unclear exactly how much fundamental underlying demand is versus the labor supply issue. So labor supply could be growing quite rapidly, and labor demand could be slowing at the margin. So the big question will be the dynamics of, suppose the unemployment rate goes up, but job growth stays strong because of labor supply. That's sort of a perfect scenario. We have deceleration wage growth, economy stays reasonably firm, and the Fed has this clear runway to do what it wants down the road.
And you think what it wants is basically nothing in the near term?
Everything's sort of perfect right now. Inflation is falling a little bit year on year. It's falling. There's a lot of noise in the month-on-month or 6-month averages and things like that. But it is falling year on year. And as long as that continues and the unemployment rate stays below 4%, I think the Fed sits tight. Why mess with something that seems to be going just fine? But leaving the option on the table, we will, however, cut rates if there's any sign that things will get worse. And I do think there is a dovish undertones, despite what the recent commentary has been. It seems to be more hawkish. But on the other hand, it does seem that they will pull the trigger as soon as possible.
Well, so in this scenario, You see 10-year treasuries stuck, yield stuck around 4.25%, but with an upside risk to 5%. What does that upside risk look like?
The upside risk is inflation gets stickier, and it seems to be a little stickier than in the past, and you see the unemployment rate drift up, and the Fed cuts rates because it doesn't have a dovish desire to support the economy and avoid recession. So in a combination of inflation staying sticky and growth being okay, but unemployment rising at the margin, the Fed becomes more dovish, and you get a steepening of the yield curve with back-end yields rising with sort of inflation risk. The other issue is debt dynamics. The Treasury issuing increasingly larger amounts of coupon bonds on their quarterly auctions. Is between, I think it was $500 billion this last quarter or current quarter. It could be $400 billion plus the next quarter. Global growth is improving as well. So it's not just the U.S. decelerating a bit from very, very strong levels last year. The rest of the world's doing better. We talk about the ECB. From the ECB perspective, things are looking on the up and up for Europe right now. And again, inflation is proving a bit stickier. They're having their scenario now, what the U.S. experienced like earlier in the year with inflation being a bit sticky. How much can they cut rates?
So there's a lot to unpack there, including auctions and the deficit and all of that, which we heard about from Steve Eisman. But before we get there, I want to talk about the reaction function in this market to data that we get this week. The idea that if we get a weaker than expected number, what bonds do. You're saying that if...
I think they'll rally. The bond market's desperate for good news, wants a reason to rally, it seems.
Okay, but what is good news, right? I mean, in other words, if you get, for example, a weaker than expected employment report, and that pushes forward the idea of closer or nearer term rate cuts, how does that cohere with your idea of a 10-year yield going to 5% on near-term rate cuts leading to stickier inflation?
It won't in the short term. We'll have to see as inflation materializes over the next couple of months whether or not that inflation number comes down at the same time as employment deteriorating. If you do get both, inflation's falling and the unemployment rate's going up, then you see 10-year bonds will be back at 4%.
This is all scenario analysis. Your baseline is basically Fed doesn't do much, right? We stay range-bound on 10-year treasuries. So what's the argument to go out the curve? Don't I just sit at the front end and just sort of like, sleep well at night?
There isn't. You're getting this is the longest inversion of the yield curve we've seen, I think, in post-war history. So what's the incentive to move out the yield curve from cash or other short duration instruments? There's not a whole lot to do that in absence of a significant deterioration in the economic outlook or a significant improvement in inflation, which will allow the Fed to bring rates down materially, not just 50, 100 basis points. We're talking about a normalization of the yield curve. Unless we're going to recession, we're not going to see 10-year treasuries below 3.75, which means cash rates have to get below 4. And that's 150 basis points away from current levels. Now we're talking the end of next year at some point, barring any real sudden deterioration. So we haven't seen a reason to extend duration. We're much more willing to take on credit risk in this environment, take on more credits than normal despite credit spreads being on the tighter side. But what's the downside? You've got a Fed willing to cut rates at the first signs of economic trouble, barring any weird inflation data. And you've got the rest of the world doing better. Yields are attractive, whether or not you think about the spreads or the absolute yield, but the U.S. high yield index yields over 7.5%. That seems to be a pretty attractive rate of return compared to a lot of other alternatives in the world.
Things could change, but I think you just explained the current dynamics in fixed income absolutely perfectly. Michael, thank you, sir. Michael Kushner of Morgan Stanley. Let's get you an update on stories elsewhere just briefly with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Waste Management, North America's largest waste recycling firm, has agreed to buy medical waste disposable company Stericycle. It's for about $7.2 billion. It's one of the biggest acquisitions in the waste management sector, and it strengthens Waste Management's position as the largest trash hauler in the U.S. The Houston-based company has bought several other disposable firms over the past few years. Saudi Aramco is planning a series of events in London and U.S. to court international investors. Aramco's $12 billion share sale on Sunday sold out in just a few hours. Now key executives will be attending roadshows in London this week with a separate event in the U.S. Foreign participation will be watched closely, considering their IPO in 2019 largely relied on local buyers. Overseas investors had questioned valuation expectations. And the Fed faces a significant risk of losing its independence to political interference if Donald Trump is elected again. That's according to the latest Bloomberg Markets Live poll survey. 14% of those surveyed said that they expect Trump to try and demote Fed Chair Powell. 44% said that he'll try to weaken Fed independence and limit its power. Now, if Biden wins re-election, 54% of those surveyed think that he will leave the Fed alone. And that's your Bloomberg Brief. John.
Danny, thank you. Appreciate the update. Up next on the program, high demand for summer air travel.
Consumer demand and that priority to invest in experiences continues to be really, really healthy. Yet the amount of capacity that we're all able to fly is significantly constrained.
Up next on the program, the view of Scott Kirby of United Airlines sitting down with a good friend of ours, Guy Johnson. That's just around the corner.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep bringing the World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City, under surveillance this morning, high demand for summer air travel.
Consumer demand and that priority to invest in experiences continues to be really, really healthy. Our industry's capacity is lower than it's been given the constraints around OEMs, whether it's Boeing or engine issues. So our economy is a lot larger than we were historically, go back pre-pandemic, yet the amount of capacity that we're all able to fly is significantly constrained.
Here's the latest this morning. The global airline sector poised for a strong summer travel season. IATA are expecting high demand to fuel over $30 billion in net income. That's up more than 10% from a year ago. To continue the conversation, good friend of ours, Guy Johnson, sitting down with the United Airlines CEO, Scott Kirby, in Dubai. Hey, Guy.
John, thank you very much indeed. If you look at the IATA data, what it'll tell you is that a lot of the profitability in this sector is coming from the United States. And within the United States, it's coming from the big carriers. As you say, we're joined by one of those now, the CEO of United, Scott Kirby. Nice to see you, sir.
Thanks for having me.
We saw a little hiccup a few days back. American comes out, it changes its guidance, the industry reacts, share prices go down. You're very quick to come out and reconfirm your guidance on the back of that. But are you seeing any indication that the consumer is softening at the moment?
You know, it's demand for us is steady as she goes. In a way, kind of boring. After the last couple of years, I think boring is good, but it really is not getting a lot stronger, but not getting weaker. It really is pretty steady.
And what changes that? Does anything change that? Does the fact that the labor market maybe started to show a few little cracks, the fact that maybe rates stay higher for longer, do any of these factors impact that strong consumer that we're seeing in the U.S.?
It could, but we spent the last 2 years talking about the risk of recession, and the consumer just keeps plowing ahead and keeps going. And so I think that's likely going to continue. The bigger thing the more likely change for aviation, I think, is on the supply side. We're at a peak where the number of seats is growing a whole lot faster than the demand in the United States. But as we move into the third and fourth quarter, those numbers are scheduled to come back down a lot. So I think the supply balance will counteract, even if there was some demand.
Where are those seats coming through? Is it with you guys at the upper end, the full service carriers? I'm assuming
it's really across the board.
Right.
Southwest is probably the biggest grower of seats, but it really is across the board. We're growing, others are growing, kind of across the board. Just the peak. This is a lot of still recovery from COVID, and this was the time that people were getting all their ability to grow back in place. So second quarter's peak.
I can see that capacity in some ways making sense at your end of the market. Does it make sense at the bottom end of the market? Do you think all of those low-cost carriers survive?
No, it doesn't make sense. And we do the route P&Ls really accurately for everyone. And, everyone that has margins lower than us has a big chunk of their route network that loses money. The low-cost and ultra-low-cost carriers in particular lose an awful lot of money. It's a fatally flawed business model.
So some of them are going to go?
I think that they're going to struggle to survive.
Okay, that's about as far as I think I'm going to get you to say that. Just back to the American issue. They pushed the corporate market very hard. Did you benefit from that?
There's probably a small benefit in market share, though we watched the data pretty closely. And while we got a little bit of market share from them, we thought that they were making up close to 100% of their revenue change in terms of distribution expenses. And so I think it's gotten a lot of press, but we certainly thought it was a marginal issue, both for them and for us.
You talk about the supply side. The industry, though, is supply constrained right now. You got an issue with the Pratt & Whitney engines that are going on 320s. You've obviously got the issues with the MAX and the wider Boeing issues right now. Is your sense that we are past the worst of that? There's worse still to come? Kind of just give us a status update.
Yeah, I think we are past the worst. I think we've acknowledged the problems by and large. You talked about two of the big manufacturers that are issues, Pratt and Boeing. I think that we're probably moving up from here. It's not going to be overnight. They're not going to get back to 100%, quickly. But that's okay. Particularly when I talk to Boeing, I'm not worried about the next 12 to 18 months. I want to get the structural, and they want to also, and then get them back to delivering high quality, delivering on time, delivering on schedule, and that's the path that's most important.
Tim Clark told me he thought that would be 5 years at Boeing.
Yeah.
Do you think that's a realistic number?
I think it'll be faster than 5 years, but it depends on them really making the kinds of cultural changes that they need to make. But if they make the cultural changes, I think Boeing gets fixed or gets their mojo back quicker. If they don't make cultural changes, they're not going to get their mojo back.
If you were to give advice to the chair on what kind of a person needs to sit in that seat as CEO, what kind of advice would you give?
So, what I hope they do is somebody that focuses on the culture of Boeing and letting the 140,000, Boeing has 140,000 great people, engineers, mechanics, let them go build, design great products, build great technology, and focus on that and not focus on the short-term financials. I think that's the biggest issue. Focus on the upfront, build great airplanes, great products, and the financials will take care of themselves. Don't try to manage the back end. Manage it up front.
Start from there. Stay with the FAA. You've been under review by the FAA. Any indication kind of how long that process is going to last? Where are we?
Yeah, everything in that process has gone well so far. No major findings. I think the FAA would tell you. I know the FAA would tell you the same thing if they answered the question. We feel good. We think we've taken this as an opportunity. Really, we had a great safety foundation, but we did have a number of events that happened. But take that as an opportunity to make not just safety number one, but top of mind awareness all the time. And I, for the rest of my career, for example, every time I talk to employees, I'm going to talk about keeping safety top of mind. We've all believed it's number one in aviation, but keeping it top of mind when everything is going great, still focus on that, all the little things, because all the little things matter.
What do you want to see from the next administration? What do you want to see from the next incumbent in the White House? What helps this industry? What helps America?
Well, it's more about help America and help the world. I think the United States I think it's the greatest country in the history of the planet. But what makes us great is positivity, optimism, vision for the future, and I want us to get back to being positive, being optimistic, looking to the future, and how do we make things better, and focusing on that. And I think we need that in the United States. I think people would respond positively to that. The world needs it, and we can make the country and the world a better place.
You are by far and away the most international of the U.S. major carriers. Do you think a Trump administration makes your job harder being an international carrier? Do you think we're going to see more fragmentation? I guess is the question that I'm really asking.
You know, I don't think it really affects demand or our ability to fly around the world in any measurable way, one way or another.
Great to see you. Thanks for stopping by to see us.
Thank you.
Scott, thank you very much indeed. Scott Kirby, John, the CEO of United here at the IATA AGM in Dubai. John, thank you.
Thank you, mate. Fantastic work over the last week. Appreciate it, not just with Scott Kirby, but also Ed Bastian of Delta over the last couple of days. Lisa, let's put those interviews together. The line that we heard from Scott Kirby of United just then, from Ed Bastian of Delta at the end of last week, we're not American Airlines.
Yes.
Seems to be the phrase on repeat in many ways.
And although Scott Kirby also saying it's unclear how terrible it was, he thinks maybe people were overreacting. Them basically saying there is stability. Maybe we're past the sort of peak acceleration in travel, the sort of recovery, revenge travel of the post-pandemic era. But stability and higher income flyers are flying, period, full stop. And so there still is that stability in profits that they're seeing.
The guy has given us a flavour of this over the last couple of days, how difficult it will be to get US executives to talk about the election and how things might change in the next 12 months. You noticed that?
Oh, I mean, that's pretty much every industry. We're focused on our consumer. We don't think it's going to be something else. We expect them to do the right thing for our country. I mean, what else are they going to say? They're the ultimate diplomats because they have to work with whatever administration they're going to be dealt with.
We'll continue trying to execute and keep on executing. In the next hour of Bloomberg Surveillance, this is the lineup for you. We'll catch up with Cameron Dawson of New Edge about that rotation. Is it going to happen as small caps outperformed this morning? We'll talk to Alex Webb of Bloomberg, our very own, over in London on the latest in NVIDIA, with that stock up by close to 2-3% throughout most of this morning. And the Marriott president and CEO, Tony Capuano, is going to join us as well. The outlook on travel there, with maybe a little bit more on China too, about how things might look in 2025 and beyond.
I'm sure that he'll weigh in on the administration and know what that means for his expansion.
He's got tons to say,
I'm
no
sure.
doubt, detailed.
I mean, look, I think that there is a really interesting aspect here. How exceptional is the United States when it comes to travel? How much are U.S. citizens going international because of the strong dollar? We've seen that pretty much with airfares. And then the other thing is, are you going to see much more expansion in the luxury asset classes just because that is where people have the capital to spend at the expense potentially of the lower end?
I think we have to tease out the politics a little bit more than that. Look, China for a long time has chosen what they would and wouldn't allow to happen in their economy. It's up to them. They've allowed certain industries in, they've kept others out. I'm thinking of tech. The United States is starting to do the same thing over the last few years. They're basically saying to BYD and some of the Chinese manufacturers, you're not allowed in. What we're going to see happen, I think, potentially, is maybe a response from China. Why wouldn't we see a response from China over the next 12 months? So if you're building up a presence in China right now and you're a US business, how much risk are you taking?
And that's something that's going to be on his mind because I believe they are expanding right now pretty significantly in China.
All of that and more in the next hour. Equity futures right now on the S&P positive by 0.2% as we kick off the month of June. What a June we've got coming up for you.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
So much growth is priced into earnings expectations, and there's so much optimism priced into markets.
I think we're priced for perfection on a lot of areas. We're very susceptible to a fast pullback again.
There is sticker shock in prices, and you are seeing the stress in businesses.
The market really has been selling off quite a bit, with technology being the only group that's still in positive territory.
We're still in a bull market, but it's going to be slowing down from here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. We've been through this lineup a few times. You know how it concludes on Friday with Payrolls Friday. The payrolls report at 8:30 Eastern Friday morning. The estimate in our survey at the moment, 190,000. Here's the number for you. Citi's Andrew Honhorst says it's the hiring slowdown, and he's looking for 140K on Friday. Lisa, you've asked the question all morning. If we get a downside surprise, how does this market respond?
Basically, what we've heard is the bond market, pretty clearly, at least in the front end, is going to rally. What we see in risk assets, though, to me, is less clear. And Andrew Hollenhorst, just to build on that, expects this to be a real weakness, the beginning of weakness that does percolate negatively into the perception of the U.S. economy and risk assets. We shall see. Last week was an interesting test where we did see weakness not translate to a rip-roaring rally the way it has in stocks, the same way that it had been in bonds.
Guy Johnson just sat down with Scott Kirby of United Airlines and tried to tease out the consumer slowing down. And what did he say? I feel I've been talking about this for the last 2 years, the recession that sort of never happened. We're having exactly the same conversation ahead of a number with an estimate of 190 and unemployment south of 4%. And here we are still talking about the same thing, about the prospect of labour market weakening being just around the corner.
Well, because this is coming at a time where a lot of people are discounting the idea of a recession ever coming. So what would the biggest surprise be? That it finally arrives, right? Because everybody has basically said, all right, we're sick of being wrong for the past 2 years and saying there's going to be a recession, there's going to be a recession, and everyone's saying, you've gotten it wrong repeatedly. So how much have we priced it out? I think that might be the question to be asking. How much have we discounted any chance of the labor market slowing at a time where people are talking about no rate cuts and ongoing strength in an equity market that is only taking a pause for a couple of weeks in the middle of summer?
This is why it feels a little bit different this time. Earnings season, and it was the retailers, a loss of pricing power. trading down, what we heard from Walmart, I've heard this a few times, what we heard from Target, what we saw from certain retailers really struggling in this environment, what many call just a more discerning consumer. I think it's the caution that came out of retail this earnings season, which maybe sort of ramps up the risk around that story just a little bit more.
Just to build on that, Best Buy's CEO came out with this. Consumers are making tough choices with their budgets. We heard also from Walmart, they're being really discerning with their purchases. All of this coming out at a time where it's clear there is pain being felt. It just isn't uniform enough to show up as true weakness in the overall numbers.
And the moment you get a glimpse of it at the individual stock level, you get absolutely punished. American Airlines, great example of that. Just a glimpse of weakness. It was poor execution based on what we've heard so far. Stock gets hammered and you start asking bigger questions. Is it them or is it the whole industry? And what we've heard at least so far is it's not the whole industry. United said it's not. Delta said it's not.
At this point, it's also who can capitalize on the wealthier customers. And that, I think, is sort of the key bifurcation. At the same time, we're going to be hearing from Marriott's CEO, and I want to hear just how much people are continuing to travel on his end as well. Then we can sort of solidify the nail in the coffin for American Airlines being their problem, not everybody else's. Maybe. Those are not my words. Yes, they are.
The airline CEOs have been sort of banging in the nails over the last couple of days.
Yeah,
Speaking of Guy Johnson.
Yeah, I know.
If you want some scores right now, here they are on the S&P 500, positive by 0.2%. In the bond market, yields lower by 3 basis points, 4.4670. It's not just a ton of data to look forward to. Also, the ECB on Thursday, widely expected to cut interest rates on Thursday. The euro slightly weaker today at 108.42, but coming off its best month on euro dollar of the year so far. Euro dollar advancing in May by 1.7%. Coming up this hour, we'll catch up with Cameron Dawson of New Edge Wealth as the first trading day of June kicks off. Bloomberg's Alex Webb as NVIDIA unveils its next-generation AI platform. And Marriott International CEO Tony Capuano as the summer travel season begins. We begin with the big issue, kicking off June following the best month for stocks since February. Cameron Dawson of New Edge Wealth remaining cautious, saying this: we see large cap equities experiencing volatility in the short term. Given fading momentum and breadth, there is plenty of room for investors to be disappointed or caught flat-footed in the short run. Cameron, I'm pleased to say, joins us now for more. Cameron, good morning to you.
Good morning.
It's good to see you. What are you advocating for this morning for this quarter?
Patience. I think patience in the very near term, just because you've had that deterioration in breadth, deterioration in momentum. It's not fatal. It's not to say that markets can't continue to rise. We know that liquidity and trend are still very positive things, but there has been this fraying under the surface, enough to say, expect a little volatility. As long as growth estimates hold in, which I think is the most important part, then that volatility is buyable, meaning any kind of correction, short, shallow, and buyable.
You say patience, there has been impatience for a rotation that's never come about. Now you've been quoting Green Day over the weekend, or at least the team has. What was it, When I Come Around?
Yeah.
Is it coming around?
No.
Or will it be a boulevard of broken dreams?
Oh, I think probably, it seems
welcome.
like more of the, yeah, very nice. I feel like an American idiot. So the challenge with small caps is that they are so unloved and so under-owned, is that you could see a very sharp rally over the short period of time that can be ephemeral. Look at the November and December rallies. They were very short, but very powerful. But if you look over the medium to longer term, you still have really weak fundamental conditions within small caps. So you have 40% of debt in small caps is floating rate. They hate higher for longer. They have 50% more debt than large caps. So we know that higher rates are weighing on these small caps. But appreciate that small caps are trading at a new relative low versus the market. So don't be surprised if you have one of those face-ripping kind of counter-trend rallies.
So wake me up when September ends. I mean, this is basically what we're looking at a time when we can't really game out when the Fed's going to start cutting rates and what the implication is going to be for risk assets. Are you saying that if there is weakness and the Fed does cut rates, that is a viable dip, particularly in small caps?
It depends what you are doing with growth forecasts. We wonder if gone are the days of the world where we are having a Fed that's cutting rates simply because inflation is moderating. If the Fed moves to cut rates or we start pricing them in, is it because of a bad reason? Is it because growth is coming in weaker? Appreciate that economic surprises have plunged over the last month. Look at real personal spending last week coming in much weaker than expected. We're watching PMIs really closely. We were hoping to see some reacceleration in PMIs. That did not happen in April. So if we continue to see this weakening of data, what it calls into question is consensus forecasts that have moved up materially. They're up 200 basis basis points for 2024 GDP over the last year. That means that nobody's pricing in a recession, which means we have to ask the question, what could surprise us?
So just to plug ISM Manufacturing coming out today at 10 a.m. I am watching that closely, as are you, as is John. Let's put some numbers on this. If Andrew Hollenhorst over at Citigroup is correct, and we get 140,000 for the headline numbers on payrolls on Friday, will there be a sell-off in the equity market in tandem with a rally in bonds?
I think potentially. We still think that bad news is bad news, simply because you have to have the context of the starting point of estimates. If estimates were expecting a recession, you could get bad news and it still wouldn't be that bad because you're already pricing in weaker growth. You're not pricing in any weak growth in this economy or in the market. GDP estimates, again, are at 2.4%, but consider EPS estimates for 2024. They're set to be up 13% next year to $277 a share. If you start asking the question if that's too high, that's when bad news would become bad news.
How relevant is the election this year to your call?
I think the election is relevant in the context of yields mostly because of treasuries and the fact that neither party is talking about austerity, neither party is talking about balanced budgets, which means that all this concern about treasury auctions likely continues, given the fact that you aren't going to see any movement to pull back on deficit spending.
So fiscal policy is a basket case regardless of who wins in November?
We're still doing the Green Day thing.
100%.
Is that what we're doing? Yeah, sure.
I think yes, because you're not seeing any sign that you're going to move to more fiscal balance, which just means that we should get used to more deficits, more high treasury auctions, and the fact that yields could be pressured higher on the long end of the curve.
At what point does it become punitive for stocks? Because we've been able to live with it for a while.
It becomes punitive if you start questioning the growth story. You can forgive a lot of things if growth is remaining resilient. You can shake off a tighter Fed, you can shake off higher interest rates, but if you start cutting growth estimates, which really relies on the consumer at 70% of GDP, that's when you have the punitive action.
You said you advise patience. How receptive are people to that recommendation, considering the fact that that doesn't really work for the DNA of most people on Wall Street?
Yeah, I think that there still is FOMO. I mean, look at GameStop this morning, and you've certainly seen a big appetite to rush into risk. I think when we think about patience, you have to consider positioning and sentiment. Sentiment is in the 90th percentile, meaning that bullishness is broad-based, as well as the fact that when you look at positioning, you can see that AAII positioning is only about 150 basis points off its 2022 highs. People are positioned for strong equity markets. So what we look at with clients is we say, if you've enjoyed this rally, you need liquidity, some kind of patience before adding back into the market is definitely warranted.
You mentioned GameStop. Can we just finish on that? The stock is up in the pre-market by 75%. Speaking of relevancy, how relevant is this? I always hear a lot of people, every time we get a move like this, they try and say, this means this. This is a signal for whatever their bias was yesterday coming into this move. What does it mean to you, if anything?
It probably means nothing, but if we can try to gain anything from it, it would be a measure of sentiment and risk appetite, as well as liquidity, meaning that if you batch all of the meme kind of speculative things together, that is a reflection of risk appetite in the market. The thing, of course, that's missing, though, is that some of your riskiest parts of the market, small caps, have been completely sitting out of this rally. So there's a lot of conflicting data points.
Cameron, this was great. Cameron Dawson of New Edge Wealth. I thought my Green Day quotes were subtle.
I thought that was great.
I thought they were subtle.
Wake me up when September ends.
Yeah, that was a good one too.
That was yours, yeah.
Yeah,
I know,
that was
I'm
good.
just reliving
Nice.
my glory by one moment.
Who's Jesus of Suburbia? Who is that? Roaring Kitty? That's me. Okay, all right. Let's get an update on stories elsewhere. We'll leave that there. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Online fashion retailer Shein is set to file for an IPO in London as soon as this week. The offering could value the company at about $64 billion, that according to a person familiar. Shein's IPO could become one of the UK's biggest ever. We reported back in February that Shein was actively looking at London after it decided that it would be unlikely that the SEC would approve it to have an IPO in New York. Former President Donald Trump joined TikTok over the weekend. It was a bid to court younger voters. He made his debut along with a short clip with Dana White of the UFC. Now both Trump and President Biden are active on the app that they have both publicly called to ban. Trump joined the platform fresh off of his conviction on 34 felony accounts in Manhattan. Trump touted that he raised over $500 million in the day following the verdict. And shares of NVIDIA and AMD both gaining in the pre-market at least about 2%. Both companies showcased a new generation of chips that aim to power the global boom in AI. At a conference in Taiwan, NVIDIA's Jensen Huang announced a new Blackwell Ultra chip for 2025. Its rival AMD also outlined plans to speed up its introduction of new AI processors. Huang said that companies who don't embrace AI will be left behind, and their tech can help firms cut back costs, saying, the more you buy, the more you save. This is CEO's math, which is not accurate, but it is correct. That's your Bloomberg Brief. John.
Love that quote. I'm going to use that. Danny, thank you. More from Danny in about 30 minutes' time. NVIDIA is higher by 3% in the pre-market. Up next, we'll get you some morning calls, plus Bloomberg's Alex Webb on NVIDIA's latest AI announcement. That conversation just around the corner from New York. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Live from New York, opening bell 1 hour, 15 minutes away to kick off a brand new trading month and a new week. Equity futures on the S&P 500 positive by 0.25%. Yields lower by 2 or 3 basis points. The 10-year 4.4689. Time now for some morning calls. First up, Morgan Stanley lowering its price target on American Airlines to 18. The analyst noting a second quarter guidance cut, but believes there's still an attractive risk reward. That stock is higher by 0.8% in the pre-market. Your second call from Citi, double upgrade for Best Buy to buy, raising the price target to 100. The analyst highlighting positive catalysts, including AI innovation. We're up by 2.3% in the pre-market. And finally, Bank of America hiking its price target on NVIDIA to a street high 1,500. The analyst citing AI tailwinds and an overall bullish outlook on chip stocks. The hike coming as NVIDIA announces longer-term initiatives, including another so-called super chip, another one. The stock is up by 3% in the pre-market. Alex Webb joins us now from London for more. Alex, let's talk about this new announcement. What's on the table now for the future?
So it just feels like only yesterday that they announced the most recent chip, which is known as Blackwell. Well, they've now announced that coming in 2025, there will be Blackwell Ultra, and in the year after that, there'll be a new platform that it's calling Rubin, named, of course, for Vera Rubin, who interestingly found the early evidence for dark matter. So I wonder if there's some sort of metaphor in there. But it's all about, of course, accelerating what they're doing right now, while others are racing to catch up. NVIDIA is going to keep moving forward, and that's what, of course, has got lots of investors very excited.
Alex, the money's real. Lisa alluded to this a little bit earlier. We've seen big spend coming out of big tech companies, the likes of Meta, Microsoft, Alphabet. You pick them, you name them, they've been buying some of these chips. Alex, how long is this runway? That's the ultimate question. How much more spending can we anticipate from some of these big players?
Well, if you look at the multiples at which NVIDIA is trading, the investors certainly seem to think it's got a long way to go. What's going to be super interesting in the next 12 months is we're going to start seeing the consumer products, in particular, that are leaning on this tech. And we did see a little bit of this announced over the past few days and past week or so, some laptops with AI capabilities built into them. But interestingly, what they do is decide what to do at the edge on the device itself and what to hand off into the cloud. And how much the demand picks up for cloud services, of course, the lion's share of that is going to be from the enterprise, will presumably then determine how much more spending the likes of Google, Amazon, with the web services, and Microsoft, particularly with Azure, are going to keep doing in order to support that demand. So next 12 months will be very, very important as we try to ascertain quite how much people are adopting this stuff.
Well, to build on what John was asking, basically, why aren't we asking, could NVIDIA shares double again in the next year? I mean, that was a question people should have been asking at the end of last year. What's the limit here? Just to ask in another way, the same question at a time when it doesn't seem like there's a competitor.
Well, we saw some announcements from AMD, which is sort of the closest thing right now that NVIDIA has to a competitor, but kind of to your point, NVIDIA grew its sales of essentially AI chips in the past year by about $100 billion. AMD is expecting to do $4 billion in the sort of comparable category. So it's got a long, long way to catch up. The kind of hurdle here is most likely to be, it seems at this stage anyway, supply rather than demand. There are only so many devices made by ASML. They make the equipment that lets you, in turn, manufacture the chips. They can only produce so many of those a year. In turn, that means that the likes of TSMC can only produce so many chips for NVIDIA. We're seeing a couple of others, not least Intel, try to expand its third-party manufacturing capabilities, its foundry business, as it's known. That might help in the medium term, but it's really supply that seems to be the biggest constraint right now.
Alex, to this point, I mean, I was looking at the profit margins. There's something insane for NVIDIA. There's something like 76%, which is unheard of for most businesses. When do people start pushing back if they are just most concerned about getting a hold of the chips? Do you see any pushback from some of the big tech players that are trying to develop their own offerings?
Well, interestingly, we did see what looked like it might be a little bit of pushback. I think it was about a month ago when it was reported that Amazon was cutting back spending on some of these chips, but then it transpired this wasn't necessarily to do with seeking more pricing power. It was actually because they want to get the next generation. And so as long as NVIDIA keeps innovating and continues to be sort of the only show in town, it's very hard to see how others will manage to compete effectively. That is, of course, why we're also seeing many of these same companies try to invest and try to develop their own competing products. It perhaps gives them a little bit more leverage when they are coming to that negotiating table. Apple, of course, is the past master at this. Presumably, some of the others will be trying to take a leap out of Apple's book and be able to play NVIDIA off against their own internal efforts in order to secure better pricing. But again, who is likely to be manufacturing those chips? If they do manage to bring them to market, it's still going to be TSMC. And so there's going to be some constraints on the supply there. NVIDIA has presumably a lot of that supply locked in for the next few years, so they really are in a very powerful position.
One of the best functions on the Bloomberg terminal, ANR. Just a snapshot, brief snapshot of analyst recommendations, and you can play around with the screen a little bit. You can take things back to where we were at the start of the year. So let's do that. I've done it just now. The start of the year, the stock is in the 490s. That's where we opened 2024. Here's the consensus 12-month price target for this stock. 654. That was only at the start of January, and we've just had a street high estimate from Bank of America of 1,500, Alex Webb. Now, the reason, obviously, that I'm talking about this is that, yes, this company keeps performing and outperforming and over-delivering, but the consensus now is 1195. And Alex, the question we've got to ask is why the sell side has really struggled to keep up with this, why this has moved so much more quickly than some Wall Street analysts who were employed to really focus on stuff like this and know much better than I would about where this is going. Alex, what are we missing? Why is this moving so much faster than everybody believed, even the most bullish analysts out there on the street?
I think fundamentally because it was incredibly difficult to predict the level of demand and whether NVIDIA will be able to meet it. It seems as though this train continues to run at a great pace. The fact that this is, the next big thing finally that the tech industry has been looking for. There was a period, of course, when they thought, some parts of it thought that the blockchain was the next big thing. This is a huge, huge innovation, artificial intelligence, and something that is very tangible. We can see the applications across the board. And I think as companies notice that their rivals that perhaps do have AI capabilities, I mean, across all sorts of different industries, companies that do have AI capabilities are being rewarded by the stock market. That also means that they then have to go and try to find these capabilities of their own. That benefits, of course, AWS, Google, Microsoft, the cloud computing companies that we talked about earlier, and then in turn that benefits NVIDIA. So it's almost like a self-fulfilling prophecy that as NVIDIA, an AI, a company that's benefiting from AI, continues to do so, others want a piece of that same tailwind, and that continues to boost the company that is making the picks for this particular gold rush.
Alex, it strikes me as we start talking about the potential valuations of this company, from a policy perspective, federally, is NVIDIA celebrated, or does it start to become increasingly questioned as a monopoly in a burgeoning and important industry?
I mean, when there are issues to do with monopolies, that is often to do with whether they have carried things out that, or enacted policies in terms of the way they behave with their customers that are unfair. I'm yet to see any evidence that that has been the case with NVIDIA. Now, is there a risk that economically, if one company sort of is the gatekeeper for a lot of this key technology? Quite possibly. But as long as they continue to have enough supply, we will, over time, gradually start to see others come into the space. It's a lot, there's a hell of a head start that they have right now. The technology is gradually going to get there, though. It doesn't look as though the sort of systemic monopoly really exists, apart from this, kind of lock on the TSMC production capabilities. But there's nothing in there which says they're doing so in an unfair manner. So it's hard to see how lawmakers can really have much complaint.
Alex, thank you, sir, for the update. Alex Webb there with the stock up by 3%. Certainly not throwing shade at the Southside community. This has been really difficult to do. The reason I frame it that way is because we just had 1,500. It would be too easy to sit here and throw shade at the 1,500. I think you've got to remember how quickly this has moved since the start of the year, that we've been playing catch-up, and in some ways that 1,500 is like catch-up to where we've been over the last month or so.
It also shows how difficult it is to quantify what the AI boom is going to look like and exactly how quickly it will benefit a whole host of players. And that's been, I think, the anxiety that's coming to play underpinning a number of different names. We just don't know. So people are all trying to game out, where they should go in terms of, the coolers for these potential processors, et cetera. How do you get an edge in a fast-moving train that a lot of people say will transform the world?
Sort of stretching for second derivative trades. I just still remember that interview with Jack Caffrey of JP Morgan and what's happened with the utilities over the last month. By the way, just got another estimate for you. This from Goldman. They're expecting a below consensus 160 for the payrolls report that comes this Friday. Consensus about 190. They're at 160. City's at 140. More on that a little bit later. Up next on the program, we'll catch up with the Marriott International President and CEO, Tony Capuano, as summer travel kicks off. Their plans for the next few months, their plans worldwide for the next few years. That's next from New York. This is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
60 minutes away from the opening bell as we kick off a brand new month, the month of June. Equity futures look a little something like this. Equity futures on the S&P positive by 0.25%, up by 0.6% on the Nasdaq. On the Russell, there's your outperformance, up by 1 full percentage point. Looking ahead to payrolls Friday. Here are the scores in the bond market, the 2-year, 10-year, 30-year, after double-digit basis point declines across the curve, 2-year out to 10-year. Through the month of May, this is what we look like this morning. We're down by a single basis point, 485.80 on a US 2-year. On a 10-year, down 3 basis points at 446.70. The 30-year, just to throw that into the mix. Yields lower there too, 461.52. Quick sneak peek of where we are on the euro. Euro dollar shaping up as follows at 108.47, totally unchanged. Though, Lisa, really decent month in the month of May for the single currency, going into what we're expected to be that first interest rate cut this Thursday.
Yeah, the best month going back to late last year, and this comes as people are expecting there to be definitely a rate cut this week on Thursday, except for that one person who we really want to interview because it seems like an out-of-consensus call given the fact that the ECB is saying we're going to cut rates. The question is, what comes after that, especially given the fact that you've gotten hotter than expected inflation rate? What I find interesting is, if they do cut rates, how much do you see people increasing some of their expectations for growth? We saw Deutsche Bank do that, but we have seen sort of better than expected economic data coming out of the region, and I wonder how much travel is going to really weigh in on that.
Are you going to have some input on that, yeah?
I'm going to do some deep research.
I think we're all going to do some deep research with the euro at 108. And let's hope it stays there. That's just a personal thing, not a bias on how you should trade, okay? Under surveillance this morning, another busy week of data on deck. The labour market in focus with jolts coming on Tuesday, ADP on Wednesday, another round of claims on Thursday, all ahead of the main event on Friday, the May payrolls report. Ahead of next week's Fed meeting, we'll also get an ECB rate decision. Bloomberg's Mike McKee joins us now for a preview of some of those data points. Mike, so 190 is the median estimate in our survey for Friday, but some below consensus calls coming through from some big banks. Citi's at 140. I've got Goldman just dropping into my inbox here, Mike, at 160. What are you and the team really focused on going into Friday?
Well, there's two things. And of course, the jobs report is the big dog of all the numbers this week. We saw a weak spending number in the PCE report on Friday, and we've seen weak retail sales numbers. We're waiting to see now if that presages a slowdown in the overall economy, a significant slowdown, and the number of jobs created and or unemployment would give people a clue. The problem is those are lagging indicators, so it may or may not come through, but that's what Wall Street's going to be watching. The Fed's going to be looking at average hourly earnings, no change expected there, but the point is that if average hourly earnings are starting to fall, then labor markets might be a little bit looser, and that is what the Fed is looking for as far as reduced inflation pressure.
I heard Danny Amanis earlier this morning refer to second-tier data. We're focused on the second-tier data as well, Mike. I'm not sure if ISM is second-tier data. I would put it as top-tier data, but whatever. Mike, when you look at the ISMs, given what we saw in the S&P Global PMIs, do you think there's some extra emphasis on those data points, both for manufacturing and services through the week?
Well, sure. It's the same question. Is the economy slowing down? Now, the ISM for manufacturing today at 10, still expected to be below 50, a suggestion that the economy is, or at least the manufacturing economy, is not growing. We get a pushback from the ISM people who say that basically we bottomed out, and if you look at the trend, it's going up. We'll see if that continues. And the service industry, obviously, the big question for the Fed and therefore for the markets, is it slowing its growth, and does that mean that inflation in services come down? So those prices paid indexes in both of those numbers are going to be perhaps the thing that people are looking at the most.
I'm also really excited, Mike, for JOLTS. I know that if you want to talk about second-tier data, that probably qualifies, especially because most people will say, well, it's sort of fuzzy in terms of how accurate it can be. Why are some people looking at this as potentially even the most important report, given the fact that it tends to be a forward-looking indicator on sentiment among businesses?
Well, our company's starting to no longer need a lot of workers. The number of job openings has continuously fallen since the beginning of the year, and that should be good news, but it's still running above the pre-pandemic trend. So as long as there are a lot of job openings out there, the theory is it could push wages up, and that could create inflationary pressures. So the more it comes down towards trend, which is around 7 million, 6 to 7 million, then the people are going to feel a lot better about the economy.
Mike, just before you run, next Wednesday, we get some forecasts too, right? How could they change on this week's data?
They're not going to change. The Fed is locked into no change at this point. What we're looking at is a longer-term change, maybe not even for July, but does it pull forward something into September or push back something out of this year entirely? That's going to be the data question that hopefully this week will answer.
Mike, thank you, sir. Mike McKee of Bloomberg, teeing us up for the week ahead. It's a massive week ahead. This morning, another big morning for NVIDIA. The stock is higher, continuing a string of AI breakthroughs. CEO Jensen Huang announcing a Blackwell Ultra chip for 2025, plus a next-generation AI platform called Rubin, set to roll out in 26. Huang saying the chip giant sees the rise of generative AI as, quote, a new industrial revolution. Can this guy say anything that sends this stock lower?
All I can say is that when I see the picture of him running out in his leather jacket, you know,
You just think of Dan Ives.
I think of Dan Ives, 100%, the rock star of the future revolution, et cetera. I mean, that seems to be what the market is saying. I think you're asking the right question. Are we even underestimating what they're going to do in terms of profitability, given that they do seem like the only game in town, and it seems like their profit margins just are shocking and continue to be so?
The stock was up by close to 30% in the month of May. Just keep adding weight to that very weighty name on the S&P 500. 1,500, the price target now over at Bank of America, which is a street high. That number coming through a little bit earlier this morning. Let's turn to this. Global Airlines on track to turn a $30 billion profit this year. The International Air Transport Association expecting North American Airlines to lead the way, pulling in just under $15 billion. The boost coming thanks to higher ticket prices and consumer demand. However, while profit is rising, so are expenses, as continued delays for new aircraft from Boeing and Airbus limit capacity. United Airlines CEO Scott Kirby weighing in on the consumer early this morning.
Demand for us is steady as she goes. In a way, kind of boring. We spent the last 2 years talking about the risk of recession, and the consumer just keeps plowing ahead and keeps going. And so I think that's likely going to continue. The bigger thing, the more likely change for aviation, I think, is on the supply side. We're at a peak where the number of seats is growing a whole lot faster than the demand in the United States. But as we move into the third and fourth quarter, those numbers are scheduled to come back down.
For better insight into the summer travel season, I'm pleased to say that with us around the table in New York is the Marriott International President and CEO, Tony Capuano. Tony, good morning to you.
Morning. Thanks
We've
for
heard
having me
from the
back.
airlines, very mixed reviews, and you're welcome back anytime. American having some problems executing, United and Delta say things are okay. In the hotel business, summer travel, just walk us through things and how they look regionally at the moment.
Well, it's interesting listening to the airline CEOs because where they're consistent is about the strength of demand. And we see the same thing in our business. When we looked at Q1 results, across geographies and across segments, we saw strong and steady growth. Now, here in the U.S., our biggest market, we are seeing demand start to normalize a little bit. We had global RevPAR of about 4.2%. It was only about 1.5% here in the U.S., 11% internationally, and 16% in Asia. Now, they're still benefiting from some favorable comparisons, but we are seeing more rapid growth internationally today.
See the same thing in the airline business, that if you have this international exposure, you seem to be doing better right now. What is that about? Is that the affluent consumer traveling more? What is that? What explains that?
Well, I think it's a few things. I think the strength of the dollar is driving lots of outbound U.S. travel. In fact, we were looking at the numbers for this summer in Western Europe, and this is off the back of a record 2023. Our forward booking revenue is up about 7%. Going into destinations like France, Italy, Spain, Greece. And I think the same is true for Asia. There was a study that just came out that said for outbound U.S. travelers, among the most desirable destinations is Tokyo. And I think that you talked a little about exchange rates.
Dollar yen 160 helps.
Exactly. The strength of the dollar is certainly driving that travel pattern.
I want to just sit on the idea of what the characteristics of some of these consumers are. Is there a feeling that wealthier consumers are going to keep traveling and keep spending, and the more you can capture them with an international offering, the better you are, versus, say, mid and lower income?
Well, I think for us, we're trying to capture at both ends of that spectrum. So we're lucky enough to have the industry's largest luxury portfolio. We announced a few more conversions just this morning. Resorts like Turtle Bay on Oahu and Pelican Hill out in California. So we continue to see really strong demand and pricing power in the luxury tier. At the same time, at the other end of the spectrum, over the last year, we have, for the first time in our 97-year history, moved into the mid-scale tier. And that is a more value-focused customer. And they are absolutely traveling. They're just looking for a better value proposition.
You talk about international travel. There is this feeling that companies that go international struggle with respect to some of the international relations that have been fraying and some of the battles they're in. Are you finding that that's become an issue?
Well, I think we're a bit insulated from that because of our business model. We've got about 9,000 hotels globally, and almost the entirety of the portfolio is owned by third-party owners and franchisees. And so in most of those markets, our owner base is a local market base, and they're based locally. So you go to China, for instance, where we're operating more than 500 hotels today. Almost the entirety of that portfolio is owned by Chinese ownership. And so that maybe insulates us a bit from some of the friction that you described.
Is that deliberate, or is that just one of the outcomes?
I think it's largely deliberate. The real estate at its core is a local business, and so aligning with partners that have deep connections both in the public and private sector, that understand local business practices, that have existing relationships with lenders in those markets has served us quite well.
You met with the president in the last month, right?
I did.
How did that go?
Great. I was lucky enough to be invited for a second time. I applaud the administration for engaging the business community, and it gave me a short window to describe what the administration can do to support the constituents we serve.
Can you share some of that with us?
Of course. So I started with our associates, our employees, and I talked about, particularly in seasonal destinations, the help we need from the administration to expand the number of temporary work visas to try and fill in some of the gaps in high-demand markets. As it relates to our owners and franchisees, I really talked about some of the constriction we see in the debt markets today. Many of the regional banks who have been big lenders into the hospitality sector are kind of sitting on the sidelines waiting to see what Basel III has to offer in mid-25 and what sort of burden that'll put on their balance sheets. And so I know in our pipeline, we've got hundreds of shovel-ready projects, which the administration was keen to hear about because of both temporary construction job creation and permanent operating job creation. But we need some help loosening up the debt markets. And then for guests, we really spent a lot of time talking about visa wait times. And so you've got a market like India. I saw this morning their stock market's going to all-time record highs. That growing middle class has a ravenous appetite for travel. But if you're an Indian national trying to get a visa to come to the U.S., the current wait time is over 400 days.
Let's just dissect some of that. Let's start on the first part, the idea that you're looking for more workers to come to the U.S. to help you out. How much does that change under one administration versus the other after the election?
Yeah, it's a great question. I'm not sure we know, right? We have seen support from the Biden administration in terms of working with Department of Homeland Security to expand some of the temporary worker visas. We'll have to see if there's an administration change, what their posture will be.
Immigration has been actually one thing that a lot of economists who come on the show talk about. This has been the big surprise. It has kept wages down and sort of kept inflation from spiraling while continuing to allow growth to expand. How much have you seen that on a practical level in your own business?
So coming out of the pandemic, obviously, we saw very strong wage growth here in the U.S., our biggest market, we're starting to see that more normalized, kind of align a little better with inflation.
But if there wasn't as much immigration, how much more difficult would it be for your business?
It would be challenging.
At this point going forward, how much are you seeing wage inflation continue to keep pace, given the fact that it is challenging, based on what you're saying, to get the number of workers?
Yeah, as I said, it's sort of moderated a bit. We're never fully staffed at the hotel level. In a pre-pandemic world, in any given time in the U.S., we might have had 4,000 or 5,000 open positions. During the pandemic and the early days of the recovery, that swelled to 12,000, 14,000. It's back down to around 4,000 or 5,000. And as a result of feeling as fully staffed as we might be, some of that wage pressure has been moderated.
You mentioned the debt markets. Let's talk about the debt markets. Sure. It depends who you are. If you're a big company right now, it is wide open for financing. Issue debt, Wall Street will eat it up. Doesn't matter where you are, apparently, right now. But if you're at the bottom of the stack, to your point, if you're local and you're trying to get financing from a small, medium-sized regional lender and you've got a couple of hotels, whatever your business might be, it's a struggle. How are you going to help them? How do you help them?
So it's, again, it's not corporate debt. It is project-specific construction financing debt. We actually see plentiful debt available for existing assets. But if you're trying to put a shovel in the ground and get a construction mini-perm loan, that is quite challenging. And the irony is, when you talk to many of the lenders and they look across their commercial real estate portfolios, they say our hospitality loans are the best performing sector, but because we've got this uncertainty into mid-25 about what balance sheet requirements we might have, often, unfortunately, they're saying, call us middle of next year.
What I find fascinating is it seems like your business is thriving. You're still seeing a lot of travel. It's not like people aren't traveling, but that it could be even better if rates were lower. Are you basically saying that the economy would just be growing at a much faster clip, that you would see that much more expansion if rates were lower, but that it's not necessarily hampering your business and your ability to grow now?
It's a great question. I think when you look at our owner community, the vast majority of them are long-term investors in the sector. And so they understand they've chosen a real estate sector that is cyclical by its nature. They are less impeded by the current interest rate environment and more impeded by just the sheer availability of new origination for construction debt.
I want to get to these three hotels. Sure. The news this morning. Can I just say, the resort at Pelican Hill, there's going to be a whole team over at PIMCO waking up this morning who know that hotel very well over in Newport Beach. How excited are you about these three names this morning you've announced?
Yeah, all three. Early in my career, I ran development in the West, and so I was in Newport Beach when that hotel was developed. As you point out, it is an iconic asset. Donald Brand and the Irvine Company have built a generational asset there, and we are extraordinarily proud that they've selected us and the St. Regis brand for that hotel. It'll be a terrific addition to the portfolio.
How do things change when you do things like this? Incredibly successful resort, very much loved in the area. Do you put a St. Regis brand on it and it changes overnight? What does that look like?
Yeah, I mean, we're still working through some of those specifics. I think the St. Regis brand will maybe be kind of underneath the Pelican Hill Resort name. It is such an iconic name, and there's so much equity in that name. This would be a good question for the folks at Irvine Company, but I think from their perspective, among the things that attracted them to us, the power of our revenue engines, the reach of our global loyalty program, and the strength we're seeing in the group segment, which is an important part of the demand picture there.
Are you going to tell me which luxury hotel in New York?
On Friday.
On Friday.
If you have me back, I'll be happy to.
All right, you give us a call.
All
Tony, it's good to see you.
Nice to see you.
Thank you. Let's catch up soon. Tony Coapuana there, the Marriott International President and CEO. The stock's doing okay in the pre-market, so you survived. We're up by 0.2%. If you were wondering. Equity futures on the S&P 500 positive as well this morning by a similar amount. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Waste Management, North America's largest waste recycling firm, has agreed to buy medical waste disposal company Stericycle for about $7.2 billion. It's one of the biggest acquisitions in the sector of waste management. It also strengthens the company's position as the largest trash hauler in the U.S. Now, meanwhile, the Houston-based company has bought several other disposal firms over the past few years. Shares of Paramount higher in the pre-market trade, up by nearly 5%. Bloomberg News team has learned that movie producer David Ellison's latest offer for Paramount includes a sweetener. Non-voting shareholders would have the option to cash out a portion of their stock for about $15 a share, which is roughly a 26% premium to Friday's close. But it's only for some of the shares. It is the latest attempt by Ellison to court non-voting shareholders who have feared his bid to heavily favored Sherry Redstone in her controlling class of shares. Qualcomm says laptop users will be able to leave the power bricks behind. It said that new efficient semiconductors will power smaller, thinner laptops.
So people are going to be able not only have the best performance, not only have the AI use case, not a very small and thin laptop, but they're going to have battery life for everything they need to do. You're going to leave your charger at home.
Qualcomm's chips will also underpin the new line of Microsoft Copilot Plus PCs. Laptops running on Qualcomm Snapdragon X Elite systems will have as much as twice the battery life of traditional parts. And that's your brief, John.
That's what we want to hear, Danny. Thank you. Better battery life. What am I using? Laptop? PC?
Well,
what am I doing?
You're using, I don't know.
Am I upgrading the desktop? Is that what I'm doing?
Yeah.
I'm going to see this big upgrade cycle of PCs.
Well, I mean, I guess if they can cook dinner for you and, you know, manage your children, which is the promise of AI.
I imagine that's not the promise of the latest Dell PC. It might be. If you want to share that with us, but I imagine it's not. Futures positive by 0.2%. Up next, setting you up for the day ahead. You're watching Bloomberg Surveillance.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question. Best question I get all night.
Bloomberg, top experts, great questions.
We are hitting the ground running, easing into this morning, and then as this week picks up, things pick up really, really quickly through the month of June. It concludes with a big debate between Biden and Trump at the end of this month. Before we get there, let's deal with this week. This is what things look like. Your trading diary to kick off the week and a brand new month. ISM manufacturing data, 10 a.m. Eastern time, a little more than an hour away. Tuesday, we'll get jobs plus factory orders and durable goods. Wednesday, ADP jobs data. Thursday, an ECB rate decision plus jobless claims. And Friday is the main event. It's payrolls Friday. In our survey right now, the estimate is 190, and we're all trying to figure out the same thing. It's the thing we've been trying to figure out for the last 2 years. Is that slowdown just around the corner? Is it like just around the corner? So let's talk about what we've heard from the C-suite so far, from the airlines, from Delta, speaking to Guy Johnson, from United, speaking to Guy Johnson, basically saying things are okay. They're not stellar, they're not fantastic, they're not running away, but they're okay. What did we just hear from Marriott?
sugarcoat a slowdown. You call it normalizing. What's the distinction between normalizing and a slowdown? Is normalizing the beginning of a path to a slowdown? Or is this really just sort of the lag effects of the pandemic coming off? What does that look like? We don't have any sense of this. And I think that's the reason what people have gotten so wrong is we don't know what normal we're going to. We talk about, for example, rates. What is a normal rate in this environment? We have no clue. What is a normal pace of demand right now? It depends which cohort you're in. Are people on a permanent vacation from being able to go to the office 5 days a week? I mean, there are all of these questions that make it difficult to know the distinction between normalizing and a true slowdown.
One is relative, the other is absolute. One is relative to where we were just before. So we are weakening, we are not weak. We are cooling, we are not cool. The other is absolute. If you landed from Mars, how would you describe the current situation? Right? If you were sub 4% and printing anywhere between 150 and 200K on payrolls, I don't think you'd describe those conditions as weak. But if I told you where we were, relatively speaking, 6 months ago, north of 2, north of 3, big numbers, you'd say things were cooler, but not cool.
People don't like to say this time is different. And typically, in historical periods where there is some sort of weakening in the labor market, typically you've seen it deteriorate pretty quickly. And the difficulty that people have right now, and this is what Andrew Hollenhorst over at Citigroup has been grappling with, people are trying to say, well, this is a normalization process that can look more like the mid-1990s where you don't see that big drop-off. He's saying it's not going to work like that, and around the margins you see that weakening. I want to see the downward revisions, what they look like, almost as much as I want to see the headline number. And then if we do get weakening, do people start to rethink what it means between normal and a true slowdown? And that, I think, is going to be an interesting kind of angst that we are seeing under the surface in terms of how stocks are reacting to some of these data points.
We've been wrestling with this for months. What is the difference, the big distinction between a welcome easing of the labor market, a welcome cooling, and an unwelcome deterioration? And it won't matter what the number looks like on Friday, we'll still be having that debate. I want to fit in this number from NVIDIA. Once again, it's higher in the pre-market. We'll talk about game, no doubt, in the next hour, but NVIDIA is just running away with it once again, up by 3.1% going into the cash open. Coming up tomorrow, let's bring you the lineup going into Tuesday. It looks a little something like this. Judith Emanuel of Evercore, BlackRock's Wei Li, former Federal Reserve, Bank of India Governor Raghuram Rajan, and JP Morgan's Kelsey Barrett. From New York, this is Bloomberg.
Day 8 of the clay court slam at Roland Garros. Coco Gauff blasted her way into the quarterfinals for the 4th straight year with an excellent win over Elisabetta Cocciaretto. The American jumped out to a 5-love lead in the opening set and didn't look back, firing 19 winners in the victory that took exactly an hour on Philippe Chatrier. And don't forget, you can watch all the action from Paris live on Tennis Channel. Our daily coverage starts at 5 a.m. Eastern.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From New York City for our viewers worldwide, I'm Matt Miller. Markets are rising in the pre-market. The countdown to the open starts right now. We begin with the big issue, and that is the consumer slowdown.
I have, as the year progresses, inflation continuing to drift down into the mid-twos. That should be, along with the type of weakness that I think everyone is expecting in the form of labor market weakening, maybe some additional consumer weakening, that should give the Fed some breath to reduce interest rates. Now, obviously, the election complicates that, and any stickiness that we see, further stickiness in inflation that we see, is going to complicate that story. But I don't have a material weakening.
All right, we saw, of course, that PCE data on Friday, which showed a slowdown, a drop actually, in real consumer spending. So after inflation, wages moderating as well, and we're going to have a busy week this week with economic data. So why not go to Michael McKee, Bloomberg International Economics and Policy Correspondent. He joins us for more. Before we get to, the granddaddy of all economic statistics coming out this Friday, let's talk about, Mike, last Friday. What happened?
Consumers spent a little bit less money, it looks like. Consumer spending came in a little weaker for the month of April. Remember, that's a delayed number, so we're about a month behind in terms of our ability to overall assess the economy. But the numbers we get from the banks who track credit card spending, et cetera, show that consumers have slowed down. And that's going to be the story of this week. Is the economy slowing down? We get manufacturing PMI coming up in just an hour, ISM manufacturing as well, and auto sales. That'll be a key indicator of where the consumer is. Have people started buying cars again, or are they still inhibited by high rates? JOLTS, everybody watches that to see if there's still a lot of job openings out there. ADP on Wednesday. That is the most famous indicator that people trade because they want to trade rather than they get a lot of information out of it. But services PMI is that day. And of course, we are watching to see what happens with service industry hiring, service industry business, and prices paid. And then we'll look at productivity and costs and jobless claims on Thursday, and then Friday. Wow. As you mentioned, the granddaddy of it all, and the payroll forecast at the moment is for an increase in jobs over last month, 190,000. That would be a sign that the economy is not cratering and not falling off a cliff. We'll see how that payroll forecast changes, Matt, over the rest of the week.
Yeah, so, I mean, it doesn't have to be either booming or cratering, right? There's some middle ground sometimes, and we are looking for a gain in payrolls. I think you mentioned 190,000. The whisper number's for a little less, 185 right now, if you check out WHIS Go on your terminal. But the demand for employees isn't there like it was, post-pandemic, right? I mean, companies aren't hiring just in case.
No, they're not hiring just in case, but they're not letting people go either, which makes JOLTS interesting, how many job openings remain out there. And of course, the jobless claims numbers on Thursday. And then everybody's going to be watching the price indicators that are buried in these various numbers during the week. Manufacturing prices paid today, services coming up on Wednesday, unit labor costs on Thursday, and then in the jobs report, average hourly earnings. Is a shortage of workers still pushing up on earnings and making a case for inflation, or have we started to see all that come down to a more sustainable level? We'll check on with you on Friday on that.
I noticed Augusta Saraiva wrote a great story on Sunday, yesterday, showing that, for example, consumer savings rates have come down to, she said, the lowest in 16 months. But I opened up the long-term chart and I see that we're back to, you know, great financial crisis levels when it comes to the savings rate. In terms of consumer debt, we're at an all-time high, right? Over $17 trillion in debt. We've added $3.5 trillion roughly of debt since the end of the pandemic, and now at a higher rate. How much trouble is the consumer in as long as, you know, she or he is still getting a job?
As long as he or she is still getting a job, not too much, because people tend to spend what they make. The savings rate, while lower, has leveled off over the past couple of months. And the amount of consumer debt is always going to rise because the country keeps getting bigger and there are more Americans out there. What's important is the debt-to-income ratio that the Fed calculates, and so far, people are still below the levels during the great financial crisis, so it looks like they can pay their bills.
Debt to income. I'm writing that down. All right, Michael McKee, thank you very much. Bloomberg International Economics and Policy Correspondent. Joining us now with a look at the stocks moving ahead of the opening bells. We saw futures are rising right now, so what's driving that is Abigail Doolittle. Abby, what do you got?
Futures are rising, but just slightly, Matt. Beneath the surface, we have some massive movers, and not surprisingly, we have some of these meme stocks to talk about, including GameStop. The shares right now up 73% off of the highs. At one point up more than a double, and this, of course, with Keith Gill and Roaring Kitty back announcing a $116 million position, plus calls. Now, it cannot be verified, but I did speak to Steve Sosnick over at Interactive Brokers, and he said that the calls in question, there is a large open interest, so it is certainly possible, and we have AMC going along for the ride. As for some other stocks that are trading higher, Stericycle, it is not a meme stock, but it is being taken over. The stock up 16%. The medical waste company is being taken over by the North America's largest waste company, Waste Management, acquiring it for $5.5 billion in an all-cash deal, or about $62 per share. The price pretty close, suggesting investors think it will get done. Summit Therapeutics up 12%. Lots of big gainers this morning. They raised $200 million in an institutional offering, and they are also expanding their license on a key drug. And then finally, rounding it out, what would we be doing if NVIDIA weren't higher, Matt? Up 3.4%. And that one's a big weighting to the indexes, so it's almost surprising to see the S&P 500 and the NASDAQ not up more. But this company, along with AMD and others, talked about the future of AI at the Computex conference. Apparently, investors like what they heard.
Yeah, absolutely. I mean, a gain there, Abby, 3.33% right now, but still not at the all-time high that we saw last week. So 1148 is the level that we hit as an all-time high. And we have kind of come off, Abigail, the highs that we had of 2 weeks ago, right? Week over week, we were down.
Well, it's interesting, Matt, because that is a bit of a bearish divergence to think about for sure. Yes, last week we were down after some very, very big gains. I would also point out that when you have these meme stocks trading significantly higher, GameStop, of course, last week or the week before did raise $1 billion. So something fundamental happening there. But does it deserve to be up 75%? That exuberance. So when you have that exuberance to the upside on some of these stocks where it's debatable whether or not it's justified, and you have the major indexes not quite able to take out their last highs, including NVIDIA, including the chip index, it begs the question of what's next. I think everybody's waiting to hear from the Fed in June this month.
Absolutely. Abigail, thanks very much. Abigail Doolittle looking at our early movers for you. Joining us now is Stuart Kaiser, Citi's head of U.S. equity trading strategy. And Stuart, what's your take on, first off, the broader markets after we hit, I think, at least 24 new all-time highs so far this year, and we've just gotten to June. How does this rally look to you?
Hey, Matt, good to see you again. Things look pretty good, I would say, but the risk-reward doesn't kind of feel as good as it did maybe a month or so ago. So, our baseline is still for the market to grind higher. We do think, strong underlying growth and strong EPS growth set a pretty high floor. But, risk-reward has been a little tricky. Last week, particularly, you had small cap outperform tech, you had value outperform growth. Some key momentum trades like copper, were down significantly. So it does seem like there was a little bit of position churning, going on under the surface. And then getting back to what Mike said, I think payrolls on Friday is an extremely important event. Consensus is at 190K, but our economists are at 140. And if you printed 140 on the back of last month's 175, I think that would definitely get markets' attention and get people worried about kind of a slowing in the underlying trend of growth. So we're still constructive, but, definitely risk-reward doesn't feel as clean to us. And that payroll print on Friday is going to be particularly important.
We did have another GDP reading last week for Q1 that was, again, lower than, I think it was 1.6% the first reading and then 1.4% the most recent reading. How do you see the growth picture? We talk about inflation ad nauseum, but we do seem to see growth slowing down.
Yeah, and from our perspective, growth is actually the much bigger risk to equity markets at this point. Our view is kind of inflation to the upside maybe gets you 3 to 5% type pullback in the S&P. But if you were printing low or negative jobs, for instance, that is what can get you that sort of double-digit pullback. So, I would agree with you. Inflation has kind of been the headline discussion, but really growth to us is the key risk indicator. Certainly the downward revision to Q1 GDP isn't great. The data last week showing a bit of a pullback in consumer spending, also not great. But, as long as claims stay, down near 200K and we're generating 175 to 200K of jobs on payrolls, then we should be okay. But, to your point, there are some, I guess what you might call cracks forming underneath the surface, and they definitely have our attention. And that's why, I kind of mentioned that risk reward just doesn't feel as healthy as it did, maybe a month or two ago.
Well, I talked about with Mike the problems the consumer is looking at. We saw spending drop, real spending drop last week. We've seen debt continue to rise. He says, debt to income is more important to watch. And granted, that's still much better than it was at the time of the great financial crisis. But interest rates are rising. So this extra debt consumers are piling on is costing more and more. How worried are you about the U.S. consumer?
Yeah, look, I think it's similar to the employment data, where if you look hard enough, you're going to find some data that you don't like. But, sort of the headline stuff seems to be holding in pretty well. So, the amount of concern that, we've gotten flagged about consumer credit card debt over the last 12 to 18 months, we probably have a stack of paper, 12 inches high in terms of stuff we've been sent. So definitely it's on people's radar. It feels like just kind of a slow-moving car crash to some degree, and the market seems okay with that. I think it's kind of like commercial real estate as well, right? You get a lot of negative headlines on it, but they just sort of seem to drip out, and the market seems kind of comfortable with that. That's why, from our perspective, yes, we respect all of those things. We do think it's impacting risk-reward, but I think until you see headline labor market indicators really start to show weakness, the equity market's going to kind of be able to hold in. So that's why I've just kind of redirected back to Friday. I think that's just an incredibly important data point for that reason.
All right, so your colleague, Scott Cronert, has, I think, a 5,100 target on the S&P. Obviously, we're well above that right now at 52 and change. How do you advise clients right now? Do you hold here? Do you take some profits? What's the move with stocks?
Yeah, from our perspective, you remain long equity risk until that labor market comes under pressure. I think Scott's bull case would be, well above 5,100, and I think you have to think about what those bull and bear cases would look like, right? If you get a soft landing economy and the Fed gets a couple insurance cuts off, then you're going to be significantly higher, right? If the Fed is forced to cut because growth is weakening, then you're going to kind of be significantly lower, and that's sort of the, those are the two barbells. From our view, what determines that you're going into that negative outcome is the labor market. So tactically speaking, we're still telling people to run long equity risk, whether that's through call options or through outright cash exposure, but to kind of, keep your finger on the trigger. And if you do see weakness in that labor market, you need to pull back fast. We don't think lower yields are necessary for a rally. And then, frankly, if the Fed is forced to cut, we think that's much more negative for equities tactically, even if it might be positive, 6 to 12 months out. So yeah, we still like owning equity risk. Jobs report jobs, labor market, consumer spending. Those are the key kind of risks to be monitoring. And, if you get a couple insurance cuts, then you just, put that in your pocket and enjoy it.
What are the sectors that you like. If you still want to put money to work in equities, where do you do it?
Yeah, it's been a tricky one just because you've had so much rotation kind of under the surface recently. We've generally been positive towards healthcare. That hasn't worked particularly well, to be fair. Having some long tech exposure in your portfolio, I think, is just a must at this point.
If you don't have tech exposure already, Stuart, you haven't really been paying attention, right?
I think that's very true. And look, I mean, that's the reason U.S. equities, I think, have been so popular globally. It's one of the few markets where you have large cap tech and growth stocks. So you have to have some tech in the book. We do like owning some healthcare alongside of that. One of the things we've highlighted recently is REITs. Not that we necessarily like them that much, but they seem to be a very, very deep consensus short. And last week, when you had that positioning moving around, REITs were up about 1.8%. So, as a tactical call, if you get a positioning, kind of unwind, I think REITs is something to keep your eye on as well.
In terms of, we talk about the consumer all the time, but I've seen slides out of Apollo from Torsten Slok pointing to, the rising earnings that we've seen for the last 3 quarters in a row are a great leading indicator for business spending. What do you think about CapEx, and can that move the needle?
Yeah, I mean, I think it can, and I think, like the Inflation Reduction Act in particular, you're just starting to see those revenues kind of now, hit the industrial sector. So I think there is an argument that, CapEx and AI is obviously going to be very big. CapEx on the build out of chip production in the U.S., very big. IRA, that revenue is just hitting it now. So, there is an argument to be made that you are going to see some CapEx go through U.S. stocks. I think the question is, if you do see that CapEx spend, then you have to assume that, U.S. corporate is fairly confident in what the growth outlooks look like. If you hear, other bank CEOs and the Fed speaking cautiously, the question is, does that cautious speak from the Fed start to erode kind of, corporate confidence in writing those big checks for CapEx? So, look, I think there are some identifiable sources for good CapEx spend, and, it's really going to be, where the rubber meets the road. Do we actually see those checks get written and those projects get done? But it does look like you do have a tailwind there, particularly in the industrial sector.
All right, Stuart, thanks so much for joining us. Stuart Kaiser there is Citi's head of U.S. equity trading strategy, talking to us on a day when we see a slight rise here in futures. We continue to see that rise mainly on the back of some M&A news, and of course there's some big meme stocks gaining today, but AI really rules all, as it has for the last couple of years. Coming up, we're going to talk more about the artificial intelligence race heating up.
Your future laptop, your future PC will become an AI. It'll be constantly helping you, assisting you in the background.
NVIDIA and AMD chiefs squaring off at the world's largest computing conference in Taipei. That conversation still ahead. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
your talent.
Britain's next was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Jobs Day, and Bloomberg has the report under surveillance.
We are seeing the labor market come into better balance.
That foundation for the economy is solid.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is not a labor market that's slowing down or grinding to a halt.
Which is why everyone is looking at wages.
Payrolls report, 8:30 Eastern Time.
The May Jobs Report, Friday on Bloomberg.
Your future laptop, your future PC will become an AI. It'll be constantly helping you, assisting you in the background. The PC will also run applications that are enhanced by AI. And your PC will also host applications with digital humans that are AIs.
Digital humans. That was NVIDIA's CEO Jensen Huang unveiling the company's latest AI accelerators. He announced a Blackwell Ultra chip, which will debut in 2025, and a next-generation platform in development called Rubin in 2026. Meanwhile, AMD announced it will speed up the rollout of its new AI processors. Joining us now with more on the AI race, if you could really call it that, is Bloomberg's Alex Webb out of London. So, Alex, it seems like Jensen Huang has, he's head and shoulders above the competition. Can AMD or anyone else really catch up to him?
I mean, head, shoulders, waist, all the way down to the ankles, I think. NVIDIA's added something like $100 billion in annual spending on the relevant chips, on the the accelerators used for AI. AMD, which is the next closest competitor, is expected to do something like $4 billion this year. So it just, say it pales in comparison. It is, doesn't even get close. The thing that is interesting, of course, is that we've just seen NVIDIA announce the next generation and the generation beyond that. Meanwhile, you're seeing a bunch of others, not just AMD, but of course some of actually NVIDIA's customers, the likes of the big cloud operators, try to get into the space too, but they are trying to get to where NVIDIA is now, right? They're moving fast to be able to stand still. NVIDIA is already on to the next thing. It gives them a huge head start, and that's not just about the actual technological capabilities, but it's also about the manufacturing capacity, because a lot of these things, or almost all of them, are made under contract by TSMC in Taiwan. If NVIDIA, we don't know the details of the contracts they have, but if NVIDIA has a lock on that manufacturing capacity for the years ahead, it makes it incredibly difficult for others to get into the space.
Yeah, I love to look at the SPLC screen, Alex, the supply chain screen on the Bloomberg, to see not only who are NVIDIA's customers, but who is NVIDIA buying stuff from. If there's a gold rush, you want to make the picks, right, and the shovels. And I noticed that memory chips are becoming kind of a bottleneck. You need, obviously, a lot of memory to run large language models. Are there other opportunities that maybe investors are digging up around NVIDIA?
Well, the memory chips thing is particularly pertinent. We've seen the likes of SK Hynix really play well in this space. It's about the next generation of memory chips that are able to respond with far greater or far lower latency, far greater speeds to the demands of the AI accelerators. Now, it looks as though SK Hynix is very well positioned at the moment. There are some others who might also manage to get into the space. Of course, going way back in the supply chain, we have, of course, ASML, which is, essentially got a monopoly on the equipment used to make the next generation of chips. They sell those in turn to TSMC, which then sells them to NVIDIA. So I think investors are starting to become savvier about this supply chain. There are a few others in the space offering discrete parts of semiconductors, but it seems as though the small number of real beneficiaries are pretty well telegraphed at this stage.
I love that ASML has like a button, and whoever's in charge of that, whoever controls the button, can turn off AI chip production for the world. So I thought that was pretty interesting. What else are we looking at in terms of like valuations, Alex? I was thinking at the beginning of last year are getting pretty frothy, but this stock, NVIDIA at least, continues to run higher and higher, and everyone I talk to, investors, tell me that valuations really aren't that high.
Yeah, I mean, look, the absolute number in terms of the market capitalization, I think it's nudging north of close to 2.6 trillion at this stage. But when you look at it as a multiple of its forward earnings, they aren't necessarily crazy numbers. Sure, it's at a premium to the market. I think it's trading at about 37 times its 12-month blended forward earnings. Now, that isn't a crazy number when you look at some of what other tech companies have done in the past.
Alex, great to have you on the program. Thanks so much for joining us. Bloomberg's Alex Webb talking to us about NVIDIA on the rise again today. Coming up, the morning calls, and then later the global airline industry is set to rake in nearly $31 billion in net income this year. We'll talk to Elaine Becker of TD Cowen. This is Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Time now for our morning calls. First up, JP Morgan downgrading Kava to a neutral, citing lofty valuation levels and saying that it prefers Chipotle over Kava. Next up, Citi double upgrading Best Buy from a sell past a hold to a buy. The analyst sees upside thanks to tech replacement cycles and says AI innovation will increase consumer demand. And then finally, CITIC Securities is cutting its rating on Dell Technologies to a hold. The PC maker fell short of expectations for its AI server business when it reported earnings last week. Coming up, we're going to talk to Tony DeSpirito from BlackRock. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is the countdown to the open. You're listening to some natural sound of the people at Skechers and Cord Energy getting ready to ring the bell. We're moments away from the start of trading. Futures are rising, not across the board. I think Dow futures are unchanged or maybe even a little bit in the red. But who looks at the Dow? We've got the Russell, the NASDAQ, and S&P futures here all up, with the small caps gaining the most, up almost 1% on the Russell 2000. In terms of the other asset classes that we watch, important obviously to always keep an eye on what's going on with the euro at 108.51, the 10-year yield at 446, 447, and NYMEX crude oil, especially today, we should be watching after the OPEC Plus agreement over the weekend. Right now down 1% at 76.18. One of the stocks that we want to watch at the open, well, you might want to, you might not care, GameStop. Surging again after Keith Gill, or Roaring Kitty, posted on Reddit showing what appears to be a $116 million bet on the brick-and-mortar video game retailer. Abigail Doolittle has more on GameStop. Abby?
There are so many directions we could go here, Matt, one of them being, have you played Uno and used that reverse card? Because the signal there is the idea that we're going to see a reverse in direction. Now, out of the April lows to the recent highs, the stock had been up more than 500%. Then out of that high into the recent lows, so much volatility here for GameStop. This stock had been down about 72%. Today, it is up 64%, although off of its pre-market or overnight highs when it had been more than a double. And this, of course, on that news that Keith Gill, who is one of the sparks for the 2021 meme rally, has a position of $116 million, an additional position, I should say, because I think that back in April, he had a pretty sizable position. In addition to buying a fair amount of calls, I did speak to Steve Sosnick at Interactive Brokers, who said that that call in question, that there is a large open interest, so it's very possible, because of course that screenshot that was on Reddit that he made of these positions, we're not able to verify it, but it certainly has created the confidence that we have this stock higher. It's not just GameStop, it's also AMC, Virgin Galactic, and some of these other meme stocks. In fact, SunPower higher, and they put out news not so long ago that they are issuing warrants to buy up to $33.4 million. So this meme rally, not only does it have real consequences to the upside and downside for investors, but these companies changing their capital structure, it's really pretty interesting to see this trend continue.
Yeah, such a huge jump that it looks like there's a halt on trading right now in GameStop shares. But $38 was the last trade, and the open was for more than 40. And of course, this is really a $10 stock a couple of months ago. Abigail, thanks very much. We'll continue, obviously, to watch that. But we're also going to focus in on the big heavy hitters, and those are the chip makers. NVIDIA and AMD rising after the CEOs of both companies made big AI announcements in Taiwan, or at least used a lot of hyperbole in talking about the future of AI. Alex Webb is back with more. So what did they give us that's substantive, Alex?
The thing that's really fascinating when you look at the way their strategy is developing is this whole first wave of AI investment really came out of the big cloud operators, the likes of Google Cloud, Amazon Web Services, and Microsoft Azure. What we're seeing now is essentially trying to eat more further forward into the value chain by getting more onto people's laptops. That will create demand in and of itself, but crucially, it's an on-ramp to that cloud demand. So it's fascinating from a corporate strategy perspective, the way they're essentially building out the demand for their products.
You know, we've seen the hardware makers. I mean, Dell is down today because of a disappointment and was down a lot the last couple of sessions because of a disappointment with earnings. But Best Buy is a big gainer, Alex, because I guess investors are betting they're going to be AI devices that we're all going to want to rush in and buy, or at least buy from Best Buy online. It's really been a hardware success story, hasn't it?
Yeah, there is, in the sort of tech hardware space, mounting optimism about a refresh cycle. When we think about smartphones, people willing to get the latest iPhone, well, they've gone from refreshing every 2 years to every 3 years, and sometimes even a bit longer than that, because fundamentally there aren't that many hardware upgrades that we've seen for much of the past 5, 6, 8 years in smartphones. As we see AI capabilities from a software perspective built into smartphones, there's going to be a need for the AI hardware to support it, and that's driving a huge amount of optimism.
On that note, I mean, I imagine you're a consumer of this technology as well, Alex. I'm using ChatGPT all the time, but when I can't, use my fingers on the phone to access it, I try and get Siri to give me the same information, and she seems fairly useless. When's Apple going to catch up?
So June 10th is the big date that a lot of Apple fans are going to be looking at. That's Apple's Worldwide Developers Conference, where they show people who develop software for their devices what they've got in the works, what they're going to be supporting going forward. And the real interest here will be whether there's support for ChatGPT hardwired into Siri, whether GPT 4.0 and others are going to be supporting the way that Siri operates. A lot of bated breath around that, and if it does happen, it will drive, again, a lot of optimism.
All right, Alex, thanks very much. Alex Webb covers tech for us out of London. Let's get right now over to our guest for the hour here, Tony DeSpirito, Global CIO of Fundamental Equities at BlackRock. He lays out his outlook, writing, quote, "The market is historically concentrated, but we expect earnings to broaden out, which should lead to the market rally broadening." And Tony, just in this, I guess, big pocket of AI, we're seeing that, right? Because it's not only NVIDIA now that's making the chips, but we're also interested in, Dell that should make computers, and Best Buy where we can go in and buy them. Like, you really do see this broadening out in terms of the consumer spend. Where else do you see it happening?
Yeah, so I think this is a really important point, because the market's been dominated by the Mag 7, but we see that moving as we move throughout the year. We see the market broadening out. You point out, even within AI itself, there's a broadening, right? AI PCs, memory stocks. AI needs to be powered, so we've seen utilities now catch a bid. The data centers need to be cooled, either through water cooling or through HVAC, right? So even within AI, we're seeing the market broaden. But if you look at earnings estimates for the Mag 7 and for the rest of the market, right now there's been a huge gap, Mag 7 winning handedly. As we go through the rest of the year, you start to see that equal out. And by fourth quarter, you see earnings estimates about equal. And we always think about investing as a combination of it's about earnings growth and about valuation. And so as you see the earnings growth broaden out, then look at the valuations. The Mag 7 trades at about 34 times earnings. The rest of the market, the equally weighted index, trades at about 16.5 to 17 times earnings. That's a really big gap, particularly when you see those estimates normalizing as we go forward. I think that's a huge opportunity for active investors.
So for active, I was going to ask if investors should just kind of take Jack Bogle's advice and pile into some index tracking funds, or if now you need to get an active manager or get an active ETF to benefit from this trend.
Yeah, so I think it's really interesting. Conventional wisdom has become, particularly in U.S. large cap space, just index, because there's not a lot, it's such an efficient market. And we've gone back and looked at 20 years of data, and if you look at the top quartile manager in U.S. large cap, that manager's produced on average about 320 basis points of alpha per year. That's nothing to sneeze at. Now, can you produce a greater percentage point alpha in some of the niche areas like EM or small cap? Absolutely. But you got to remember the size of the U.S. market is just so important, U.S. large caps and clients' portfolios. You know, U.S. large caps make up about 63% of the global MSCI ACWI index. If you think about the Russell 2000, which is the basic U.S. small cap index, the market cap of all the companies combined in that index are about the same as the largest single stock U.S. large cap stock, Microsoft. And so I'm not suggesting that I think it's a question not of or, I think it's a question of and. I think there's a lot of opportunity to get alpha through active management, even in U.S. large caps, particularly when you think in terms of alpha dollars, right? The percentage alpha times the amount invested. That's where I think you're really missing out if you're not looking for alpha in U.S. large caps.
Well,
as you point out,
well, I was just going to ask about the ETFs, because I've talked to you before on the ETF program, which, by the way, airs today at noon. You run the BlackRock Large Cap Value ETF, right? And you guys have gone big into active management ETFs. You have dozens of them out there. I know that investors have put a lot of money into those. How have they performed relative to their benchmarks?
Yeah, so I think active ETFs are a really interesting development. It's another way to deliver alpha to clients, another form, another wrapper. And some of the advantages of the wrapper are transparency, intraday liquidity, tax efficiency, et cetera. And we at BlackRock, really tried to marry our world-class ETF franchise with our world-class active franchise. And we've launched 36 funds, active ETFs that now have about 13 billion of AUM. I'm particularly proud of the one that I've launched, the BlackRock Large Cap Value ETF, BLCV. We launched that just over a year ago in May of last year. We produced over 700 basis points of alpha since inception. And so it's something that we're really excited about for sure.
What are the risks that you're worried about, Tony? I mean, we kicked off the show with concerns about the consumer. We saw on Friday, real spending has dropped. We've seen, this huge amassing of debt for the consumer with rates that continue to be higher. So, all the new debt that you're racking up is even more expensive than the old debt that you had. Is that one of your chief concerns?
Well, so first of all, the history of the market is about climbing a wall of worry. So there's always something to worry about. And I think, particularly I think this goes back to the advantage of active. How do you position against those worries? So what am I worried about? Am I worried about valuations? Yes, when you look at the S&P 500 overall, you see valuations are elevated. They're not off the charts, but they're elevated. The market's over 20 times earnings. How do you solve for that? Well, certainly going beyond the Mag 7 is one way to solve for it. Value investing is another way to solve for it. The portfolios I run on average have a PE multiple about 12 to 13 times current earnings. Are you worried about the economy? Sure. Debt is high, so you know what? Focus on companies that have really strong balance sheets, that have high quality earnings, et cetera. And so I think, yes, there are things to worry about, but there are ways to solve for that within an active portfolio, and that's what we're doing here at BlackRock.
All right, Tony, great talking to you. Thanks so much for joining us. Tony DeSpirito there. He's the global CIO of fundamental equities over at BlackRock. Coming up, high demand for summer air travel.
Demand for us is steady as she goes. In a way, kind of boring. After the last couple of years, I think boring is good, but it really is not getting a lot stronger, but not getting weaker. It really is pretty steady.
We'll give you the latest on the global airline industry amidst a windfall of profits. Next, this is Bloomberg.
names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
Breaking U.S. PMI data crossing the terminal right now. For that, let's go to Bloomberg International Economics and Policy correspondent Mike McKee. Mike, what do we have?
Well, top of the show, we were talking about whether the economy is slowing or not. The S&P PMI suggests manufacturing is certainly not slowing. Comes in at 51.3, that's up from 50.9, and the forecast was also 50.9, no change, but it looks like we have a gain from there. We have seen strength in manufacturing in a couple of different places today, in Spain, in Germany, and in the Eurozone overall. We've seen numbers come in at or better than they had been, but this is the highest one around. So pretty good news. Coming up top of the hour, we will get the ISM Manufacturing Index. It is expected to rise but be below 50. Let's see if it too can top that level.
So, all right, this is the S&P Global U.S. Manufacturing PMI. So positive surprise means, is the economy not slowing down?
Well, manufacturing, at least, is not in terms of the responses to the S&P index. Essentially, when you go below 50, you're looking at some contraction. So manufacturing picking up, according to S&P, and we'll get numbers, as I said, at the top of the hour on the ISM, and then Friday we'll see what manufacturing payrolls look like, see if they have fallen off at all.
All right, we'll be watching closely. Mike, thanks very much. Michael McKee there with your PMI data, 51.3, so better than the survey, which was 50.9, and better than the prior at 50.9 as well. The global airline industry is on track for a strong year. IATA, which is the International Airline Association, expects high demand to fuel over $30 billion in net income. That's up more than 10% from a year ago. Joining us now to discuss is Helene Becker, Senior Research Analyst at TD Cowen. So, Helene, this seems like a very good sign for airlines. What's gone right for them this year?
Yeah, it's a good summer. And a lot of what's going right is people still want to travel and they still have the means to travel. It's slowed a little bit from the 22-23 I guess, hysteria we saw in terms of people trying to get out and we're tired of being cooped up. So I think we've reverted to a more normalized growth rate. But still, when you think about the size of the world's economy, not just the U.S. economy, but the world's economy, which is what IATA looks at, what we're seeing is very strong demand worldwide, and the size of economies has grown in the past 5 years. So you would expect natural growth to occur, and that's what we're seeing.
Are these airlines globally capacity constrained? Because I notice here in the U.S. at least, every time I check in, I'm asked, how much I'd be willing to take to give up my seat. And indeed, over Memorial Day weekend, there were a lot of flights canceled because they were just overbooked.
Yeah, well, canceled and delayed because of weather also. That happens a lot too, especially in the summer months. The winter's a little bit easier because snow storms are a little more predictable than pop-up thunderstorms. But I think the way to think about the capacity issues are there are delivery delays from the OEMs, so airlines aren't getting as many aircraft as they thought they would. But the impact is really on aircraft retirements. Airlines aren't retiring aircraft as rapidly as they have in the past. And then the other issue with the Pratt & Whitney GTF engine issues, those issues are not going away anytime soon, although as we go further into the decade and Pratt gets more experience in repairing them and more facilities open to repair the engine issues, you'll see that abate as well. But pragmatically right now, we just have a limit on how much airlines can grow because they can't get new aircraft. They're keeping older aircraft in service longer, which means they go into the maintenance bays a little bit more often. And although the airlines try really hard to get all that maintenance out of the way before we head into June, July, and August, things happen. It's sort of like with your car, things happen, and you have to handle it when it happens. But I think in general we're okay. We have enough pilots, and the IATA forecast you referenced. Remember, they're a worldwide organization, so they're looking at Asia, South America, North America, Europe. And so for that forecast, and I guess Asia, if I didn't mention that, so that forecast just encompasses a really good environment. When you think about the way things recovered in the last 4 years, you saw, North America kind of recover first, then Europe, Asia's recovering this year. So you see the demand kind of move around the world that way.
Helene, we just saw the year-to-date performance of these airlines, and there's a massive divergence, right? Delta is up 40% year-to-date. American Airlines is down 20% year-to-date. What is Delta doing right that AAL is getting wrong?
Yeah, so American has had a really tough time of it recently, and a lot of it just has to do with the way they're growing coming out of the pandemic. So if you look at United and Delta, specifically, United and Delta just grew differently. They didn't retire as many aircraft. United especially didn't retire any of its wide-body aircraft, and Delta kind of used the opportunity to clean up. But American retired almost all their older wide-bodies, and it was a good guy, bad guy then. On the positive side, they were able to narrow the fleet types down to 5 from 9, but on the negative side, as international has grown faster than domestic in the last year and a half, they're not participating in that. So that's one thing. The other thing is United and Delta especially, have both renegotiated their credit card loyalty agreements, their co-brand credit card agreements. And Delta said in their last annual report that that contributed $6.8 billion to revenue, and that is on its way by the end of the decade to $10 billion. We think United, which hasn't disclosed it, is somewhere in the vicinity of that, maybe a little bit less. But we know American is well below that because they haven't renegotiated their contract in more than 5 years. So they're in that process now. That should catch up, and that's probably a second half 24-25 catalyst for the shares. But pragmatically, they've just handled things so differently, and especially on corporate, where they just forgot that corporate would recover as people started to go back to the office. And I say 4 is the new 3, and people over the next few years will be required to be back in the office 5 days a week. It's just the way things are going.
Yeah.
And as that happens, people will travel more, and American kind of forgot that. So they've got a little bit of rebuilding to do.
All right, Helene, thanks so much for joining us. Helene Becker there. She's Senior Research Analyst over at TD Cowen, talking to us about the airlines. Now for some of the other sector price action this morning, let's get over to Bloomberg's Abigail Doolittle. Abby?
Well, we do have the S&P 500 up about 0.3% right now, Matt. So sector-wise, we're looking at more sectors higher than not, led by tech and healthcare. Tech, of course, having to do with some of that chip action you were talking about before, healthcare on some of the summit news along with other news. Energy down 1.3% in line with oil. Very quickly, Matt, you were talking about the Dow. I think it went above 40,000 very quickly. I don't even think it closed above that level. But since going above 40,000, take a look at the divergence between the Dow and the Dow Transports and the NASDAQ 100. It's unclear which of these indexes is quote-unquote correct, but certainly worth taking a look at.
Yeah, really interesting split there. Abigail, thanks so much. Coming up, the market-moving events you need to be watching today. That's in our trading diary next. This is Bloomberg.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Time now for our trading diary. The ISM manufacturing data coming out in just a couple of minutes' time, and tomorrow we're going to get the U.S. JOLTS numbers. Mike was telling us about that. Wednesday, the ISM services data, and Thursday, an ECB decision to watch. Finally, on Friday, of course, the U.S. payrolls, non-farm payrolls data coming out. This is Bloomberg.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast. That's where you'll find us. Alex Steele is off today. No problem. Jess Metten's sitting in for Alex.
We're back. I'm excited. It's going to be a lot of fun.
It's like she never left. She just slides right into the chair and we're good to go. We're going to take a look at the markets here. We're going to take a look at some ISM economic data came out a little bit weaker than expected. We'll break that down. Dan Ives, Wedbush Securities, will talk tech. Margie Patel, Senior Portfolio Manager, Allspring Global Investment. She's up in Boston. She'll give us her market call here. She's got a tremendous amount of experience. We appreciate getting some of her time. Let's kick everything off this morning with Mr. John Tucker.
All right, thanks, Paul. Market Drivers Report being brought to you by Interactive Brokers. Interactive Brokers charging U.S. dollar margin loan rates from 5.83% to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. We are data dependent, so let's get right to it. The Institute for Supply Management, the manufacturing index, remember that's the second biggest part of the economy, coming in lighter than expectations and lighter than the previous reading, 48.7. And remember, 50 is the dividing line. Anything below 50, contraction. Anything above that number is expansion. 48.7. The prices paid index, that's over at 57 right now, a little less than the previous reading and less than the expectations. The reaction will go to the bond market 2-year yield, which is more policy reactive. Right now, that is down 4 basis points. That is at 483. Among the most active stocks, GameStop, influential trader Keith Gill, also known as Roaring Kitty, behind that move. On Reddit, Gill posting a screenshot showing what appeared to be his holdings, including 5 million GameStop shares. The surge in meme stock trading may indicate a market top At least that's according to Dennis Garbman, chair of the University of Akron Endowment Committee.
The fact that when the public comes in aggressively and trades meme stocks, trades SPACs, trades single-day options, trades over-the-counter stocks, trades less than dollar stocks at a high rate, that's always disconcerting to me, and I think it should be disconcerting to everybody else.
First week of June, monthly employment report. That is probably the marquee event on the week's U.S. economic agenda. Going to get that Friday. S&P 500 right now 10 points higher. That's up 0.2%, 5286 in the index. The Dow Jones Industrial Average 91 points lower. That's down 0.2%. The Nasdaq 100 90 points higher. That is up 0.5%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, thank you so much. We appreciate it. Jess Menton sitting
Happy
in
Monday.
for Alex Steele. How are you doing this morning, Jess?
Doing fantastic. Unfortunately, going to read off this latest headline, though, on the terminal about the New York Stock Exchange. So equities investigating a reported technical issue. If you remember thinking back to last week more broadly, we did see some issues where the S&P 500 and the Nasdaq 100 hadn't been ticking for a little bit over an hour, but those individual stocks were still able to trade. So, but this, if you look here today, though, they are investigating a technical issue that's supposed to be more confined to just a handful of particular shares, but we have our equities team all over that right now, so we'll keep you updated.
What is the problem? I mean, they're supposed to be tech savvy.
Yes, exactly.
Right.
I mean, it's just, this was like for an hour on, was it Friday?
It was actually earlier last week, right? And so it was actually a little bit over an hour where the indexes weren't ticking higher for the S&P and the Nasdaq 100. I talked to traders on individual trading desks as well as the New York Stock Exchange, and a few of them at the time didn't notice because they were still able to execute those orders. So they were surprised to hear from me. But apparently, John Tucker here, a hero that I heard about, saving lives on the...
We're not going there. We're not going there. Turnpike accident, car fire,
John
extraction.
Tucker was there helping people out. So
Always.
I burnt my
good
shirt.
Samaritan. He's a good Samaritan.
He
We
is.
appreciate that. All right, we had some ISM manufacturing data came out just this morning, a little bit weaker than expected. Let's bring in Tim Fiore. He's the chair for the Institute for Supply Management. The kids know that as ISM. Tim, talk to us about the data we saw today. I'm just looking at the headlines. Came in a little bit below forecast, a little bit below last period as well.
Yeah, hi, Jess. Hi, Paul. So the best way to describe this report, although our number is contracting again, is stable, stagnant, stuck, sluggish, and flat. So, the preponderance of the comments indicated over the last couple of months we're kind of on a plateau. As you know, your listeners, we started to see a grow out back in January. It was a weak grow out, not a very strong grow out. But in the month of April and then again the month of May, we're basically stuck. And it feels, the reason why we're stuck is that there is very little demand. And the reason that there's very little demand is because people are waiting for rate cuts. So when we started the year, the rate cuts were actually a tailwind. Now with the lack of rate cuts, we're actually looking at a headwind. So the manufacturing sector is pretty much frozen, and they're unwilling to really invest in CapEx and in working capital and to some extent in people until the horizon clears up.
So, Tim, what does this mean more broadly for the economy?
Well, I think we're 6 to 9 months out ahead of the general economy. So, we started to grow out in January, as I said, which would indicate that maybe the general economy would start to see a better uplift in the fall. But with this plateauing, this could be just a manufacturing plateau, depending on what the Fed does on the rate side. But I don't think we're going to see much movement here. I mean, as time goes on and there's a lack of demand, there's going to be a lack of work. One of the really positive things here of the report is that we were stable on a revenue basis month to month, which is good, but we've been expanding slightly for the last 3 or 4 months, and now we're stable, which really means that as your pipeline, your backlog, declines, you have less to work on. We could see that production number go into contraction, which would be a whole different story. Right. So that's the first story here. I already mentioned the demand. It's the weakest new order number we've had in a year. Last May was worse at 42, which is a lot worse than 45, by the way. But it's okay. We're not as bad as last May. And then, the positive thing here is on the prices number, where although we're still expanding, we're not expanding as much as we were in April. And we just finished our forecast, and our respondents have indicated that for the whole year 2024, we're looking at a 1.9% price growth on the cost of things that they buy. of which we've already seen 1.6% so far this year. So if you take that, it really says that we're looking at, essentially, not much more of a price increase as we close on the year. And, hopefully that will spur some demand here. But, I think, everybody's waiting for a little bit more solidity and some positive news here so that people will move on. In the meantime, we've gone from a profit-focused performance year to a profit-focused performance year with a bigger priority on making sure you're liquid in the event something wrong happens. And that's kind of where we're at.
All right, Tim, thanks so much for joining us. Always appreciate getting your thoughts here on ISM Day. Tim Fiore, chair for the Institute for Supply Management, talking about these ISM manufacturing numbers came in lighter than expected. Again, the one that jumped out at me, Jess, was this new orders came in at 45.4. Consensus was 49.4, so a big miss there. Last period was 49.1, so the new orders kind of gives you a little bit of a leading indicator, weaker than expected. Looking at the markets here, we've got red and green on the screen, led by the NASDAQ up 0.6%. The Dow's off just a couple of points here. Let's bring in Abigail Doolittle. She does this market stuff for a living. We appreciate getting a few minutes of her time. She joins us here in our Bloomberg Interactive Broker studio. Abigail, what are we looking at here today?
Lots of different things here. I want to start out, which is nice. It's nice to have something to talk about in the month of June ahead of this Fed meeting. I want to talk about first, and this was not on the plan necessarily, but with that ISM number and those new orders that you were just highlighting, Paul, we have seen a little bit of a negative reaction for the equity indexes. Now, nothing major, but the indexes had been up a bit more. Right now, the S&P 500 up about 0.2%, whereas the Dow down about 0.1%. And the reason I say this is the reaction from stocks to the ISM number that was a miss. Bad news is bad news. Now, it's a tiny, tiny degree, but it's also shown bad news is bad news with yields lower. Typically, that would help out stocks, but that's not really the case here. I think that there are some new concerns around the state of the economy, and these numbers may help to highlight it. Now, that's the first thing. The second thing, with the Dow down about 0.2%, something that I've been talking about over the last couple of weeks, I know we don't talk about the Dow so much, but the Dow briefly went above 40,000. I don't even think it closed above that level on an intraday basis, and since then has basically gone back down. Not basically, it has gone down below 39,000. Right now, around 38,612. Down from that peak by, let's call it 5%, a real divergence from the other indexes. Now, third, let's complicate the picture and bring in the meme stocks. GameStop up right now 24%. For any other stock, you would be like, wow, but given the fact that this stock had initially been a double on the news that Roaring Kitty has a bigger position and has bought some calls, when you have these indexes trying to flirt with all-time highs, not quite busting through, and you have these sort of speculative stocks up in a big way, and you have this divergence between the Dow and the other indexes, lots of uncertainty.
All right. Abigail Doolittle, thank you so much for joining us. We appreciate it. Abigail Doolittle, she covers all the markets for Bloomberg, and we were fortunate to get her in our Bloomberg Interactive Broker studio. Let's talk technology.
Let's do it.
Why
Switch
not?
it up.
I mean,
also,
why not?
with apparently what the New York Post calls the best dressed man on
Well,
Wall
that's
Street.
debatable, dude. I mean, I actually have a problem with his wardrobe, but I tend to look past it. Dan Ives joins us because he's a big Penn State fan, so I look past it. Dan Ives, Managing Director, Senior Equity Analyst for Wedbush Securities. Hey, Dan, thanks so much for joining us here. Let's talk about chips. And we talk about AI, and you've been on front of this AI trade and really getting people up to speed on AI and how to play it. But are we still focusing on the chips here? Is it NVIDIA and everybody else?
I mean, look, it's their ultimately, it's Jensen and NVIDIA's world, everyone else paying rent.